optionality which comes in as well. So net, it's a positive. The fact that we are also amidst a big heat wave right now should bode well for the stock after it's corrected from the peak.
With no help from you, though.
No help from me. No, actually, yes, I do consume a lot of their zero sugar products, and which account for actually nearly 30 to 40% of their revenue, which is also gross margin accretive. Not only is sugar bad for your health, but it's bad for the company's gross margins as well, because sugar is expensive.
Live a little, yeah, Mangala.
I do.
Okay, well, I think we've got the first rates come up, and Varun, of course, is up about 2.5% at the end of the pre-open session. But we'll look at that. We'll, of course, the cement space in focus, and so many companies which reported numbers. Nykaa, let's just put that up quickly if we have like a second or two. Put up Honasa, where that is at the end of the pre-open session, how they likely to start. 7% on Honasa, 3% on Nykaa. Paytm is higher, that block's gone through, and of course JSW Steel is the other one, and so many others. Ixigo, we spoke with the management earlier, that should come up as well. LIC, Yash told us his numbers are strong. Max is down about 2%. Oro Pharma, I think the call's on 1.7% lower on Oro Pharma, 1520, and there's more stuff. So we'll get to these individual names, but you get a broad sense of where they start. We'll look at indices first, as we always do, before we go down to individual names. So 23,700 on the Nifty. It's up about 0.16%. The Nifty Bank is up about 1/3%. The small cap index is up 0.7%. The mid cap index will come up as well. And we've got about 140 points, about 1/4% gain on the mid cap index. 1,230 stocks are higher, 400 stocks are lower. It's about 3:1 in favor of advances. So 23,680 on the Nifty is what you have. So it's flattish but slightly higher. Heat map will give you a sense of how the 50 stocks are opening. Trent is up the most. Tata Motors passenger vehicle is up next. Grasim, Maruti are some of the others. And Max Health is starting lower. On the other end, ITC and Infosys are some of the other names. Rima.
Well, Max is clearly the problem stock in the large cap space. Max is open with a cut of about 5%. And here, their share of oncology has declined sharply on a quarter-on-quarter basis due to discontinuation of select chemo drugs for institutional patients. So that's weighing on the company's performance. X of that, the company's gross revenues, X of oncology, was up 15%. But consolidated numbers are a miss. Stock is under pressure. Along with that, ITC, where again, the change in taxation weighing on cigarette volumes, and the street is still unclear on the trajectory of the cigarette volumes, at least for the near term. LTM is reacting negatively to the acquisition. They've gone ahead and announced an acquisition of Randstad in Europe. They will be paying $160 million. But maybe it's to do with the acquisition or the overall IT space, because generally the Nifty IT is in the red, and Infosys, Wipro too have opened with cuts of about 1/4%. Titan, L&T, Cipla, Hindalco, these are some of the other names in the red. On the way up, Maruti Suzuki is being rewarded for its announcement of price hikes of up to 30,000 rupees per vehicle. So that's the top gainer. Tata Motors passenger vehicles higher. Insurance companies, SBI Life up and about, NTPC, Eicher Motors, Adani Group stocks. In the banking names, ICICI Bank and HDFC Bank too have opened up in the green. But on the whole, very quiet and still very much consolidating in that band.
Consolidating at the front line end, but a lot of individual stocks doing a thing of their own. We have Honasa, which is the stock of the morning, up nearly 10% post its best ever quarterly performance that has come in. WeWork India was locked in upper circuit yesterday post numbers, continues to do well, up 7% straight off the bat this morning as well. The Travenews Techs, Ixigo, we just spoke with the management. It was a soft quarter, but maybe the street is looking ahead and believing that maybe their agentic AI business, along with the fact that demand for summer travel is fairly strong, and the stock which has corrected a fair bit as well. They've given them a long rope. RCF, the EBITDA was up 80%. That stock too, up around 5% in trade. LIC is the other one, which is up 4%. Yash told us it was a good set of numbers. Page Industries is the other one. Reported numbers ended about 1% higher. I think the street likes the management commentary that came by in the conference call that reflects in the stock price, which is higher by about 4% after having seen a big outperformance in the recent past for that counter as well. In the F&O space, we have Varun Beverages, which is opened about 2.5% higher on that revised agreement with PepsiCo. FSN Ecom, which is Nykaa, is also up 3% on reporting a stellar performance. And Dalmia Bharat, on account of the acquisition. We just spoke about that, up around 3% as well. So a bunch of stocks doing extremely well. The only one that stands down, however, is Aurobindo Pharma. Ekta did tell us that those numbers were largely in line with expectations, if not marginally better. But the street seems to have, not been as charitable to the stock. It's down about 3.5%. And then we have a big cut on names like EIL and Quick Heal, both of them down 6 to 8%.
There's a lot happening, right, in terms of individual names. And look at MTAR Tech. It's again come up with huge volumes for this point in the day. It was like a super rocket stock. I mean, it is still the best performing stock on the NSE 500 universe. It gave you a quick 10% drawdown, 10% pullback. It fell $1,000, and it's just come up very, very quickly, right back to an all-time high. So it's a new all-time high for MTAR Tech after that 10% drawdown that we saw recently. Page Industries, I think Mangalam mentioned that, is up 5%. Sansera is another one, right? It's gone up like a rocket. It's up 75% in 2026 so far. Close last year was 970. It's at about 2,900 now. The results came through a few days back. 2 days back, it was at just under 2,500. So that is another one, huge mover in that sense. Adani Energy Solutions is up 3% this morning out of that group. It's doing the best right now. WeWork, I think we mentioned it, is up 8%. So that's a large one. Tech Wabag is up 2.5%. We have the management joining us in a bit from now. So it goes. So, there's enough and more activity action. LIC, of course, is up 4% as well. You'll hear from the LIC management a little later during the day as well. Max, of course, is now down 4.5%. Paytm is also down about 3%. Oro and Prestige and Welspun Corp. Welspun Corp has been a big, very strong mover. This year it's up 50%. That includes today's 5% cut after numbers, but it's still up 55% for the year so far. LG India has not really performed. It's down 2% after numbers as well. Rate Gain is down 3%. Datamatics is down 5.5%. So many moves coming through. Rana Gupta is with us, senior portfolio manager and India equity specialist at Manulife Investment Management. Rana, good to have you with us here. Thanks for joining us. What should we start with? It's earnings season, I think, is pretty much coming to an end. We will get a flurry of numbers as we wrap this up. But how consequential has this earnings season been? Because, we are in the midst of this higher energy impact, and that will only show through in the first quarter numbers and maybe in the second quarter as well. So it's all kind of, the waters have been muddied a fair bit in that sense. How does one make that assessment? Rana.
Hi, good morning. So the results are not quite reflective of the macro environment that we are seeing, because in India, the consumer so far has been largely insulated from the oil price rise and other price rises. But that said, this result is a good indication that last calendar year, the income tax cut, the GST cut, the rate cut that has happened, that has taken impact, and the domestic economy is doing well with inflation so far under reasonable level, which means the economy is quite resilient. And that's why we expect that even if the policymakers decide to increase the oil prices, and we think they should, we think that looking at the resilience and looking at the slack in the inflation, there will be some pain, of course, but I think there is room to absorb that kind of price rises.
Hi, morning, and thank you very much for joining in. So what's the call now that you're taking on the Indian markets? It's been a painfully long period of consolidation. We haven't done too much. Are you bullish or are you turning a bit cautious now?
So I think there are so many macro variables out here. We have to first outline my base case, and then we can talk about Indian markets. The base case remains that the Strait of Hormuz opens somewhere in mid-June. And even then, the crude price, we do not think comes back to where it was pre-war. So therefore, some of the price hikes are necessary, because right now, because of crude prices, India is having to pay additional about $60-70 billion for crude and fertilizer. Right now, government, the public companies, and to some extent corporates are bearing this. that situation cannot sustain. This has to be passed on, and that is what we think will happen. So that is the best case. That said, I think now we see we'll move to the market. In the market, we see quite a bit of opportunities actually on a sectoral basis. Firstly, the globally linked sectors like power equipment and metal, they should continue to do well because of the global capex that we are seeing in artificial intelligence, infrastructure, and defense. Coming to country specific, we quite like the capital goods sector, and within that, we like defense. Outside that, in the broader industrial space, we like the infrastructure sector because we think in India, some of the infrastructure plays, the balance sheet is quite solid and cash flow is very visible. So we like that. And secondly, moving on from there, we also like in the consumer space, the consumer retail or platform companies. You were yourself highlighting some of the results that has come through, that consumer retail and platform companies, they continue to gain share in the Indian market. So that is one space, whether it is jewelry, whether it is grocery, whether it is eyewear or beauty products. I think some of these companies continue to gain share, and this is one space we have liked for the long term. Lastly, we see some revival in real estate and building materials as well, because we are quite optimistic on the data center kind of infrastructure and also some of the revival in commercial offices. For once, we do not think that AI will cause significant job losses in India. Of course, Indian IT companies can lose share, but we think the GCCs are there to pick it up. So we are quite constructive on that real estate part and commercial part as well.
Right. So there's a comprehensive list of opportunities that you see in India. What about the travel and tourism portfolio? Because, it was expected to be a big growth driver for the country, but in the very near term, it's facing a fair amount of headwinds. Inflationary headwinds could lead to some sort of discretionary spending being pulled back. Do you think that would weigh in on some of the hotel stocks, some of the travel and tourism stocks?
Yes, sure. I think it's already weighing in, and I think in travel and tourism, currently, I think there will be some pressure for a few more quarters, given we are also expecting or advocating for an oil price rise, which will lead to high transportation cost. So I think, but that said, if one were to take a step back and take a view for 1 to 3 years, we do think the premium hotel stocks are kind of pricing this in, and cyclically, I think there is if you look through the near-term pain, I think there could be a good opportunity. We would be a bit cautious on the airlines still because, airlines has significant operating leverage. While crude might fall, they can rally, but I think we will be a little cautious. On the other hand, coming to the travel-related portals and technology side, I think this is where if the travel portal is just an aggregator, this is where I think the threat from agentic AI is the most. So again, I cannot say in a blanket view, but we have to understand the company's agentic AI focus and how are they planning to beat that, because this is one area which is actively disrupted by Gen AI.
We've seen some strong numbers from these consumer platforms like a Nykaa or Honasa Consumer today. Stocks are racing away on the back of their numbers. Are you bullish on this particular side of the platform companies, new age companies?
Yes, we like the digital companies for a long time. And we like some of the older companies in the jewelry space also, because we treat them as a platform. Outside that, we also like grocery retailing. That is one platform we like. We like the beauty and personal care platforms. Also, we like eyewear platforms. So you will note not all of this is purely tech. Some of this is physical, some of them are digital, some of them are phygital. The point being that because of the superior proposition, they are gaining market share. And that's what we like.
Yeah, point taken. By the way, the market's making a bit of a move now. So 95 points, 23,746 is where the index is now trading at. And it's 1,500-1,600 stocks higher and about 1,000 stocks which are lower at this point. Consumer durables, Rana, any thoughts? Diversified names like LG India. Do you have a view?
The consumer durable will still have somewhat of a difficult time because of the input price rises. So in this case also earning cuts are yet to come. But again, just like I commented on travel, if someone were to take a longer term view, We think a diversified white good company can be a good pick for the longer term if one can avoid next 1 to 2 quarters. I will be cautious of consumer durable companies which are narrowly focused on one or two verticals because that is where the input cost will be the most and most impacted by competition. So, large, diversified, premium white goods play, we would be optimistic, but there will be challenges for the next few quarters.
What hospital names? Do you have a view?
Sure, I think you can also think of it as a platform business, right? Because these are, or even this is a cross section from between platform and infrastructure business. So, see what they do is not only they're gaining market share, but once the digital or the physical platform is built out, there is little fixed cost to service their additional customers. So when they build, they go through pain or let's say stagnant earnings, and when the building is complete, the earning inflection comes. A lot of these platform companies, whether it's retail, whether it's physical or digital, we have discussed today, we believe that in FY28 and FY29, they are poised for significant earning inflection. Today, I know it's FY29 is a slightly longer term looking, but in 6 months we will start talking about that, and I think then we will realize the earning power and the cash flows that will come from this kind of companies. And yes, that includes hospitals.
Just put up Keynes, if we will. That's Keynes Technologies. Had a very sharp sell-off. From 4,500, we went to about just under 3,000. And it's coming back a little bit, just a little bit. From the lows, it's pulled back, right? So 29.95 was the low. It's about 3,200, trying to move higher. So 2.25%. Dixon is up today as well, about 2.5% at this point in time. Any views here, Rana?
The EMS is one sector where we have been bullish, and although the stock prices have not really responded in this particular sector, the EMS sector, while the long term remains very good, but the EMS sector, we have to understand, they are going through some transient but significant challenges. If you think of all these companies, the input prices are all linked through copper, memory, and all those gold and silver, which are seeing significant price rises. So this will impact their margins. This will impact, and if not margins, will impact the volume. And these companies operate on a fairly low operating margin number, so therefore earning downgrade can be quite significant. So this is where I think earning downgrades can continue to happen for the rest of the year. The long-term picture remains, India's electronics export story remains good. In that case, we have always said that if one were to back any company here, back the ones which has strong cash flows and ROEs. The what has played out in this sector is what we shared with one of the earlier discussion with you. In this sector, because the margin is already low, if someone is buying a company which is growing strongly with low working capital, that can get into a lot of trouble. Because if the operating margin slips, working capital slips, your cash flow situation deteriorates extremely quickly. So that is something one needs to guard against in the EMS sector. But the other companies with stronger balance sheet, with good cash flow, ROE, should continue to do well. Again, I think some of the other sectors have cautioned for about 2 quarters. In this case, I think it can continue for 3 to 4 quarters.
What about the financial space? I have to ask you, because most portfolio managers, most investors, etc., they, because of its weightage on the index and because of the long outsized opportunity in India, are fairly sanguine on this space. But in the very near term, there are a lot of headwinds out here as well, right? With regards to the cost of funds, with regards to credit offtake, perhaps because of higher inflation, maybe at some point you get some of the balance sheet troubles as well. Is there a possibility? Where are you on the financial space, and your thoughts on public sector, private sector, NBFCs, the other ways to play it?
Sure, I think that's of course you're right. This is a very large space and one is to have a view on the sector. Now, per se, I think the Indian financials, the results were also quite good, and we are happy to see that most of these financials, they have made preemptive provisions for for any possible West Asia conflict. So that's a good part. I do not think situation will deteriorate to the extent, and you have to remember my base case that I outlined earlier. We do not think situation will deteriorate to the extent that their balance sheet will impact it, because all of them have very pristine balance sheet. They have provision cover, and therefore they can withstand that. There is a resilience to withstand some bit of impact. So therefore, we do not think the balance sheet will get impacted. Where it will get impacted is in growth and margins. There we think markets current estimates are slightly on the optimistic side. And also, if the deposit the growth cannot pick up, we think credit growth has to kind of come off a bit, and or people will have to fight for deposit raising the rates. So the risk is on the growth and the margins, not so much of the balance sheet. Among the private banks, we like the ones, or even the public sector banks. We like the banks which have a lot of liquidity in the balance sheet and have room to lend. So, for example, the banks which have lower LDR and high LCR. So those are the banks we like, where they can continue to support growth. Moving to NBFCs sector is also something that the larger NBFC we are comfortable with, because many of them have raised capital, and having raised capital, they can withstand a rising rate or even a somewhat deteriorating asset quality scenario. Within the entire financial space, the part we like the most is still the financial services. Financial services space is, I think, has a long runway, and there is a lot to like about it. Within that, whether it's exchanges or insurances, those are the things that we like.
Thanks very much for that. And Rana, it's a good chat, detailed chat, and we look forward to our next one. Thank you for joining us here on CNBC-TV18. You know, we put some data out yesterday that after the rules changed from the 1st of April, there has been a rush of buybacks. You know, Nimesh compiled this data, and we put this out on the editor's playbook yesterday, and the numbers are there. I mean, of course, 24,000 crores, but bulk of it from Wipro and Bajaj Auto. But there are, lots of other smaller sized, buybacks which have been announced since. Sign, for example, Aurobindo is there, and so on and so forth. So this is, the initiative, the change in rule has been taken up by promoters and companies in a significant way, and it's just been not very long, a month and a half or so. Bhavesh Shah is with us. He's Managing Director and Head of Investment Banking at Equirus Capital. We also have Devyansh Nasa, Partner, EY Pathinan. Gentlemen, great to have both of you here. Thanks very much for joining us. Prashant this side. So, Bhavesh, if I can start with you. Is this, as I said, Bajaj and Wipro, of course, accounting for the bulk of it. But lots of, the list is long. Transaction size, etc., is small. What are you seeing out there in terms of companies and interest and just intention to do this? Buybacks after the change in rules?
Hey Prashant, good morning. Good to be here. Thanks for having me. If you step back and look at the capital market environment right now, of course, there is a volatility out in the market. At the same time, a lot of these companies believe that they have excess cash, which can be used better from a capital allocation perspective by giving it back to the investors. That's one. And the second, one of the biggest triggers has been one of the recent changes by SEBI in terms of making buyback more palpable from a taxation perspective, and as well as, more market friendly. So I think, companies can buy back from the market. I think, these sends out very strong signals to the investors that, company believe in their growth story going forward. And, this can be a very EPS accretive strategy. Clearly, I think some of these companies want to make sure that the investor interest is alive in this counters, and this buyback help in that respect.
So the first thoughts from you, Devyansh, what are you seeing in terms of interest and pipeline from here?
Thanks, Prashant. So, I concur. There have been three major changes which have happened, which has led to this. We talked about the tax reset, which is now it's more clearer, it's more fair, more predictable for stakeholders. there's a cash surplus that is available. But there is another angle that we should think about, and that is the 12% surcharge, which comes on promoter capital gains from these buybacks. And that could somehow change the maths for some founder-heavy companies. So I wouldn't be surprised if some of them pivot back to dividends instead of using buybacks, or maybe go for using cash for inorganic plays instead. But certainly, as we look at it, there have been 25,000 crore worth of buybacks, and it's growing.
So what is, just explain that surcharge point, Devyansh, if you will?
Yeah, so it's basically coming in on the promoter capital gains from the buyback. So if the promoter is selling in, there is a surcharge which the promoter has to pay.
I see. So you're saying that may disincentivize some of the founder-heavy companies to do it and maybe use cash elsewhere.
That's correct.
Right. Bhavesh, any thoughts on this particular point?
So I think, I think essentially what SEBI wanted to make sure is that the new rules are not misaligned from a promoter and a shareholder standpoint. And we had seen instances in the past where buyback was used by the promoters to kind of make gains for themselves and rather than shareholders. So I think what SEBI has done is disincentivize the promoters by participating in the buybacks, by including this surcharge. Effectively what it means is, there's a clean way of getting the, buying back from the shareholders into the company. The promoters are not participating in this buyback, and that kind of, from a SEBI's perspective, would lead to a little more transparent and fair process of creating these buybacks.
Yeah. So where is there a sector where we are likely to see more of this, Bhavesh? I mean, just to drill it down.
Absolutely, Prashant. I think we will see more of these in companies which are obviously very cash throwing. Not very heavy on capex, not very heavy on maybe acquisitions. Of course, you could see acquisitions across, but effectively sectors like technology for sure. So I think wherever they don't have specific needs of capex coming up, some of the pharma companies, wherever there is a cash, we'll definitely not see banks doing this. We'll definitely not see infrastructure companies doing it for sure, because they will need cash for growing their businesses. But it will always be cash throwing businesses and industries where we will see this action.
Is there like a how much is enough as a strong signal? Is there a science to this?
Great question, Prashant. I think my personal view is, I think it's more of a signal that really matters. It's more of a confidence that the company is exuding to the investors at large. But at the same time, I think the company has to also be cognizant of the fact that what are the kind of signals it is sending out to the investors. Of course, the price is down, and we are there to buy at and support these prices. We think this is a great EPS accretive price. But the other is, the signal which the company is giving out to the investor world at large is that I'm not acquiring. There's not major capex. The growth plans are going to be whatever they are organic. So I think the companies need to be very calibrated in terms of what is the signaling and what is the messaging. The investors are able to grasp by way of this method. So,
Bhavesh, I get that. I'm just saying that how much needs to be done so that the signal is strong enough and it's not a weak signal.
No, I think you can't have smoke without fire. So I think you need to. I think they're very difficult. There's no specific science to this, and I think it all depends upon the market conditions as well. But something. If the companies always announce and do nothing, the next time around, investors won't take it seriously. But if something is done, I don't know, there's 10%, 20%, 25%, 50%. Very difficult to put a finger on a number. But I think the actions need to follow the talks for sure.
Yeah. No, that most certainly. And I mean, year after year after year, if you look at markets like US, etc., there is, of course, earnings growth. Now earnings growth, because of the last few years, is very strong. But otherwise, during periods of low earnings growth, buybacks have resulted in, large, have accounted for large amount of growth in US, hundreds of billions of dollars every year in the US over the last, I think 10 years more. So, of course, the size here is much smaller, but we are starting to see some of it. We'll track this space. Thanks very much, Bhavesh, for joining us on short notice. Divyansh, thank you very much for being here on CNBC-TV18 as well. We'll take a break. We're back. The management of Tech Wabag joins us on their quarterly performance. Stay tuned.
Welcome back. You're watching us here on Corporate Radar as we speak. The market is, it's recovering, but at high levels, like we pointed out earlier, it's seeing some sort of resistance. The good part, however, is that the Nifty is above the 50-day moving average. 23,750 is where we are on the Frontline index. It's being led by the Nifty Bank, which is higher by about 500 points, but a little over 54,000. We have resistance. It's coming out there as well. So let's see how that pans out. Advanced decline split right down the middle. Tech Wabag, that's the management on our show right now, reported a good set, especially given the likely disruptions from West Asia. The revenues jumped 22%, margins have fallen. Rajiv Mittal, who's the chairman and managing director at Tech Wabag, joins in now. Thanks a lot, Mr. Mittal, for joining in. It's a good performance. The question, however, is what goes on from here on three parameters. One, order wins because of the disruption in West Asia, etc. What's the kind of order inflow outlook that you have? The second part is on execution, because we've been speaking to a lot of people and they say that labor availability, execution remains a bit of a challenge. And then the third part is on raw materials. So cost of execution has increased. On all these parameters, what's your guidance? What's the outlook? What's the setup like?
Thank you, Mangalam, and thank you for having us on your show. I think we are still very bullish. I've said this before, that today we are a multinational company with presences in more than 25 countries. So we are not dependent on one geography. Our risks are spread out. And even when you're talking about West Asia, I think all our execution of the projects are very much intact. And we have been performing well. All our sites are not disrupted. We have adequate workforce to give the desired output, and you can see from the numbers we have exceeded our expectation. So there is no disruption per se in the execution side. On the order intake side, I think we are at all-time high with 17,200 crore plus order backlog. So we are not short of orders. Yes, definitely we have seen some delayed decisions over the last 3 months. But I think it's fine. We are full with execution. It's a matter of time. And water is something where the decisions cannot be delayed beyond a point, both in the drinking water side or in the wastewater side, because it affects directly the people. So we are very much intact, and we have a very bullish order outlook. And last thing about your raw material prices, most of the orders which are under execution, we have already blocked our cost by placing orders both on the construction and on the supply. So we don't see much effect on the present execution. And the new orders, obviously, when we take, there will be a clause to negotiate if there is a continued to be price increase. So there also we are not very concerned.
So can you put numbers to the qualitative commentary that you've made? What's the kind of order inflow guidance that you have for this year, revenue guidance and margin guidance?
I think, Mangalam, we have given this 3 years back. We don't give year to year or quarter on quarter guidance. We have given a 3 to 5 year guidance, which is, we are very much on it. You can see even this year, revenue guidance are very much what we had given. We had given a 15 to 20%, and we have already achieved more than 20%. And with the kind of order backlog we have, I'm sure we can do much better than 20%. When we will give our next guidance in next year, probably you will see that this CAGR number of 20% will further go up. And same thing on order. You have seen in this crisis, the water has come into discussion. They have been all talking about destroying each other's water assets. So I'm sure each country is going to build adequate reserve capacities of this water. So we see going forward, the governments are going to come up with a policy to have a spare or buffer capacities, which will also help us to build new plants.
And even the margin guidance of 13 to 15% stays despite the inflationary impulse going up?
In fact, Rima, yes, it does. And you have seen even this year, we are both on standalone, we are 14% plus, and on console, we are 13% plus. So yes, this margin guidance will stay and can improve.
Right, Mr. Mittal, good morning. Water has been in the headlines, water desalination plants and threats to destroy it and whatnot, right? I mean, absolutely crazy stuff. Just one thing, in the Middle East, what is the value of projects under execution on some of the on the plants? I mean, total value in the region, Middle East?
It should be close to about 5,000 crore plus. Don't hold me for this number.
No, we won't.
I'm guessing it will be of that order of magnitude.
Okay. And work on all this has continued through this over the last 2 months.
Yes, absolutely. And in fact, our people are very much there. They're all safe. We have housed them closer to the sites. We have thousands of laborers working. We have not seen any disruption. We just have to be very careful because the countries are very well organized. If there are any alerts, we just put them under safe shelter. Otherwise, the work is going on as usual.
And that point that you mentioned, which is building buffer and spare capacity, have you seen any actual visibility? People picking up the phone and talking to you that this may, or have you seen this come through the pipeline with regards to, just projects being conceptualized or maybe just the idea being floated?
Very much, Prashant, and we have seen it, and people have started talking about it. They have started hiring some advisories who can plan for this reserve capacities to be built. So like they used to build for oil, I think water is going to be the next oil, valuable resource, which is going to be taken care by building spare buffer capacities. 100%. It's only a matter of time.
Right.
Okay. Sir, there were two likely large orders from Saudi Arabia and Kuwait. CNBC had reported it. And you had confirmed participation in them. Can you give an update on the status? Is it a part of your order book right now, that's 17,200 crore, or a part of L1, or when do you expect it to convert?
Rima, first thing, we don't take orders in our order book if we are a preferred bidder. Okay. I think you're talking about two orders. One is in Kuwait, which is $384 million. This is not in order book. We are a preferred bidder. Other one is Hadda, which is a sewage treatment plant, another about 200 million plus. Both are in our preferred status, not in order book. And this should happen very soon. It's just got delayed, as I said before, maybe by a quarter. We definitely see this in second quarter or end of this quarter. We'll see this into our order book.
All right. That's good enough for you to, confirm what our colleague Vivek was picking up earlier. You will perhaps get the order and reported to the exchanges by the second quarter. For now, you are the preferred bidder. Thank you so much for joining in, Mr. Mittal, and giving us the update. As you were speaking, we did have some updates coming on MTAR Tech as well. They've bagged orders worth nearly 500 crore rupees from an international entity. The stock has been a buzz for a while right now. Maybe a part of this was what the street was sussing out, and now that we have the reason coming by, the stock continues to hold up high by about 4.5%. 500 crore order coming in.
25,000 crores on market cap now, and it's the best performing stock in the market.
Only Sterlite Tech perhaps has been.
Yeah,
but it's a much smaller company. Yeah. But this is a stock which has done well, even on days where there is news, no news, and on days where there is some news. But let's move on and talk about Healthcare Global. Next management on the show. The company has seen an operational improvement in Q4. Revenues are up 11%. The average revenue per patient has gone up by 3% and now stands at more than 84,000. Manish Matu, Executive Director, CEO at the company, Healthcare Global Enterprises, is now joining in. Thank you very much, Manish, for joining in. Rima here. Q4 revenue growth at 11.5% is slightly lower than the annual guidance. For the full year, you've met it. But particularly in Q4, it's been moderated. You've spoken about the low margin business exit, impact of Middle East, the medical tourism, etc. So I get over the medium term, you will get back to 15%. But just as this conflict continues to linger on, do you expect maybe in the first half of FY27, revenue growth will trend below the 15% mark, or have you seen an improvement in April and May?
Hi, thanks, Rima. Good morning. I think in Q1 there may be some impact, but I think by Q2 we'll get over it. So I think we should come back to our guidance of 15% by end of Q2. That's where we feel. And it's not just the Middle East conflict that's impacted the revenues. It's also the fact that we have intentionally decided to pare down the low margin business in some markets. And that's showing up in our increased profitability and margin expansion.
So so for the full year, it's a 15% revenue guidance holds, right?
That's right.
Okay.
That's right.
What about our margins? Because you have exited the low margin business, which is diluted. But on the other hand, you're also expanding or opening up in North Bangalore, which will take some time to break even. So I suspect this year it could be a drag on your margins. What's the margin guidance for FY27? And when do you get to that aspiration of 23-24%?
So we've stated, Rima, that in the medium term, we are looking at a 22-23% margin, and that going up to about 25% too. And I think we are on track to hit that number. Because the measures that we've taken on margin expansion are actually showing us good results. This quarter alone, the margin expanded by 100 bips, almost 100 bips. So I think for this year also, we have baked in the fact that there will be some EBITDA dilution coming in from the new facility, but our margin for a 20% plus growth stays, and we are on track to get there.
Got that. Let's just... good morning and good to speak to you, Manish. So where will all this expansion come from? I mean, asking a hospital company, how will you increase margins and keep increasing margins usually is we're all consumers of healthcare services, so we don't want to pay more. But you got a business to run. Where will this expansion come from, Manish? Since the P guys came in, will you has everything been done to kind of has the revamp, or whatever you want to call it, scaling back unprofitable divisions and reducing the sprawl? I mean, all that is done and now you're just executing, or there is more action left?
No, yes, of course. See, it's a journey. It's a journey, and as I've said, margin expansion of 100 bips every year is what we are targeting, and there are several levers that we are going after. Payer mix is one such a lever, and we've seen great success around it. Price increase in several markets is on the anvil, and that should also help us increase the margins. There is investment happening in clinical research, in new technology, in clinical onboarding, and of course, upgrades in our infrastructure, increase in patient outcomes. So all that is going to add up to increase margins in several of our markets. Other thing you have to realize is that many of our centers are maturing. Clinician productivity is increasing. The operating leverage is something that we are seeing in most of our centers coming in. That all those put together will definitely help us increase the margins. At the same time, we continue to invest in newer formats like daycare centers, newer technologies like MR-Linac in the new hospital that we recently launched, in genomics, proteomics, so that the clinical
Manish,
differentiation that we are known for.
In terms of, the flagship hospital in Bangalore, right? How much is that as a percentage of revenues?
So by end of this year, it'll be about 3% of our overall revenues. So the impact on margins and revenue is not going to be significant. But next year onwards, I think there's going to be a significant scale up.
You've also agreed to exit the non-core fertility business, Milan Fertility brand. You get about 37 crore on account of that. That, when you couple with the rights issue that you did, what is the capital deployment plan, and what was the final trigger to sell the fertility business? Why now?
So the trigger really was that it was non-core to us, Nima, and it had been running as a scaled down version, and we were not able to expand and meaningfully impact that space. And as has been stated, our main core will be to invest in oncology going forward. So it was really a non-core business which we thought was best to divest.
Right.
And the deployment will happen in expansion in the brownfield and greenfield projects, which are coming up this year. We plan to expand by about 200 beds over the next 24 months. And this is the capital that will be deployed for that.
Right. Just a final question before we let you go, Manish. You said that you do have a bunch of levers and you have a lot of metrics that you're tracking for growth out there. So if you could lay some of them out for us in terms of average revenue per patient, average revenue per occupied bed, the kind of growth that you're seeing out here, along with the international business as well. Kenya saw a strong growth. What's the average revenue per patient out there, and what's the trigger here?
So average revenue per patient is twice as much in India there. And that's done extremely well for us. For the year, it's grown 39%. For the quarter, it was at 71%. So I think Kenya is going to be a big market for us. But not just Kenya. I think Bombay, Ahmedabad, Bangalore, Vizag, and Calcutta and Ranchi. I think these are 5-6 hubs that will continue to grow quite rapidly in the next year.
And what are you targeting in terms of payer mix?
Payer mix shift, we've already seen 100 bips improvement in the last couple of quarters. And we aspire to double that in this year.
Sorry, that question on the Bangalore hospital, I think as a percentage of total revenues, you said what's the number?
So it's about 2% by the year end.
No, so the Bangalore flagship hospital revenue.
No, not the flagship. I thought you were talking about the new hospital. Sorry.
No. I'm talking about the flagship hospital. That's got to be much higher.
So the flagship hospital is about 16-17% of our overall revenues.
Okay. And which is the next one after that?
It'll be Ahmedabad.
I see. So just a quick, are there any plans to kind of grow, because you're present in lots of centers, but you're known in a big way for the flagship, but that's true for others as well. I mean, Apollo in Chennai, etc. But is there kind of sort of, plans to grow another center to sort of make it a regional hub kind of a thing, which...
Right. Yeah. So that's actually happening in many of our centers, whether you take Borivali in Bombay, you take Nagpur, Nashik, Vizag. We have 2 hospitals in Vizag, or the Calcutta hospital. Many of our centers are now closing to the 10 crore per month mark or more. Many of the centers are now trending between 10 to 15 crores per month. So I feel the next wave of growth, besides the 2 hospitals that I mentioned, of course, they'll continue to go quite healthily. The next wave of growth is going to come from these second rung of hospitals, which will continue to grow in double digits this year and then the subsequent years.
Okay. All right, Manish, we'll leave it there. Thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC-TV18. Thank you. Well, 116 points and markets looking strong. We have Sudeep Shah of SBI Securities with us with a quick check on technical. Sudeep, how do you read it? We are at almost 23,800. Back at 23,800, I should say.
Good morning, Prashant. Prashant, what I feel is that 23,600 now will act as a very important support. Last few days, we are seeing Nifty visiting with this 23,550, 23,600 mark and not convincingly even closing below that. So that is coming out to be a very important support. And on the other hand, 23,830, 23,850 is acting as a resistance since last 6 to 7 sessions. So what I feel is, looking at the volatility index, looking at the way the mid caps, small caps, and select large caps are shaping up, eventually we might head towards 24,200 levels. So buying on dips would be my strategy from here on, with 23,550 as a support on the downside.
And stocks?
Morning, Rima. The stocks that we like, there are two of them. The first one is Hindalco. We have seen a strong uptrend in Hindalco since last several weeks. And now the stock is sustaining at higher levels, closer to 1100. So here, this can be bought with a stop loss at 1065. And the targets for the same would be 1145, 1170. The second stock, which is there on our radar, is from the auto ancillary space. It's a mid cap. And the stock is Gabriel India. So here also there has been a strong up move in the last several weeks. Post that last 5 to 7 sessions, there has been consolidation also. And the stock is holding firmly above the 200-day moving average as well as the 20-day exponential moving average since last 7 to 10 sessions. So what we feel is that from here on, around 1107 is where the stock is trading. The stop loss would be 1065. The targets would be 1150, 1180 on the upside.
All right. Take that point. Thanks a lot for joining in and giving us your views, Sudeep. We'll take your leave on that note, and we'll actually take a short break as well with the news that the Nifty is doing extremely well right now, over 100 points, led higher by the Nifty Bank. On the other side, Manisha Gupta joins in with a focus on the commodities space.
Welcome back. Let's talk commodities. As promised, Manisha is now joining in. Manisha, what are you looking at?
Well, I'm looking at the crude oil prices. It continues to be quite volatile, choppy for the whole of this week. Overnight, we've seen 2% of a decline come in. And for this week, with that decline, we're down by nearly 4% for the Brent crude prices. For this year, though, we're still 70% on the higher side therein. The U.S. Secretary of State Marco Rubio has said that there were some encouraging signs on a possible deal with Iran. That is what the markets are dealing with. But in the meanwhile, you also have statements from Iran reportedly working with Oman on framework for permanent toll system at Strait of Hormuz. This is something that the U.S. does not like, and most of the oil producers also would not want this. So this is where the market seemed to be stuck at this point in time. Also, in addition to that, it is going to be the OPEC Plus meeting on 7th of June. That is what the street will watch out for. The 7 OPEC Plus countries may hike output yet again for the month of July. Though without the UAE, what are those numbers looking like? And the spare capacity that the OPEC holds is something that the markets will be doing maths about. And then there's an estimated 8.5 million barrels per day of global inventory decline that the street is now putting out. We have a similar statement coming in from Goldman Sachs, from JP Morgan as well, suggesting that the decline in global inventories is quite sharp, especially when you look at the average numbers for the month of May. If the transit through Hormuz resumes in third quarter, then the prices are expected to slide below $95 a barrel. The street is also anticipating that by the fourth quarter, there would be some normalization back into the street as well. And that could look at the Brent forecast at around $80 to $89 a barrel therein. But even with that, it does stay above 80 no matter what. IEA in the meanwhile also cut the 2026 demand forecast by nearly 420,000 barrels per day therein. So the demand growth for 2026 almost cut to as low as 500,000 barrels perhaps, and that would continue to weigh onto the markets therein. For the prices itself, when you look at the second quarter, the current quarter that we are in, the Brent is averaging at around $106 a barrel. And that's exactly what the markets do believe that we could be looking at the crude prices going forward as well. So when you look at all of those forecasts coming in, take a look at the EIA suggesting that $96 a barrel is where they see the crude prices averaging for the rest of 2026. Now, you have Goldman Sachs talking about $85 a barrel of an average. $100 is what Barclays has put out. Zanalyst talks about a range between 95 to 105 is where the crude prices perhaps will stabilize going forward in this and the next quarter as well. World Bank also has upped its average for 2026 for Brent at $86, and JP Morgan talks about 96. So that forecast or those prices of 60s and 70s that we saw before West Asia conflict perhaps are absolutely done away with. Most average forecasts coming in anywhere between 85 to 105 on the higher side.
All right, Manisha, thank you very much for that. We'll take a break. We are back Indianomics with Lata. She speaks with Anand Narayan and Mridul Sagar on options before the Reserve Bank to defend the rupee. Stay tuned, coming up.
Welcome to Indianomics. The rupee has recovered a tad over the past 2 days, but remains one of the weakest Asian currencies in 2025 and 2026. Since the closure of the Strait of Hormuz itself, Feb 28, it has fallen nearly 6% again, more than other Asian currencies. The government has taken steps like raising gold import duties, cutting fuel export duties, etc. Raising fuel export duties, etc. The Reserve Bank has cut speculative positions of banks. Now, what else? Today, I have with me two stalwarts to discuss what more policy options the RBI has, which could come, as early as in the upcoming policy. But separately and importantly, we are also going to discuss if interest rates should be used to defend the rupee. My guests are former SEBI member Anant Narayan and former veteran banker. The other guest, former Reserve Bank ED and MPC member, economist Mridul Sagar. Let me add at the outset, I am not saying at all that RBI will use rate hikes. We are having an academic argument on whether we should begin thinking about rate hikes to defend the rupee. So, Anant, Mridul, with that intro, welcome to the show. Thank you very much for joining me, Anant, especially in the studio. So, let me start with you. We'll come to the interest rate debate in a bit. First up, without counting hikes, what more does the Reserve Bank have? They went hammer and tongs at the bank speculative positions. Can they do any more?
Sure. Thank you for having me, Lata. So to start with, yes, there is overreaction happening in the currency market. But I think it's important to take a deep breath and ensure we don't panic and hyperventilate. The reality is RBI still has $580–590 billion of net reserves, even after counting the forward sales. So there are plenty of buffers available to manage whatever crisis unfolds over the next few months and weeks. So that we should take a deep breath and start with that and not start to shoot in all directions and try and see what can be done. That said, of course, there are things that need to be done because, as I mentioned, there is an overreaction happening in the rupee. I think the rupee has moved far away from its fair value. And one of the big components of that, I think, is sentiment. The reality is the demand for dollars that is emanating right now is not just your traditional balance of payments components like current account deficit or FDI or FPI. It is more the fear and greed trade also playing in terms of very negative sentiment, which is coming in and buying in dollars.
Yeah. Can you give those numbers, FY26?
So, I had done this math this is an estimate, for FY25 and FY26. I estimate that the RBI has sold between spot and forward markets about $190 to $200 billion in the currency markets. Against that, if I look at current account deficit, the FDI numbers and the FPI in equity for those two fiscal years, that's about $85 to $90 billion. So my point is that the amount of dollars that the RBI is selling, about $110 billion for other purposes, which is likely hedging or speculative positions, is actually higher than the gap that you're seeing on the balance of payments, the normal components. So that sentiment has to change. And specifically, and also let's look at this, we are talking about a current account deficit for FY27 of 2 to 2.5% of GDP. This is nothing. Yeah. We've lived with these numbers forever. So
for 3-4 decades.
Yeah, the average, I think, since the beginning of the century is around 2% of GDP. So these numbers are not extraordinary at all. So one of the reasons why we should not be panicking is precisely this. It's about getting 2% of capital flows again, net capital flows again, which is not beyond us.
Okay.
So I think changing the sentiment, particularly with respect to capital flows, would be a big area of my focus. There are hundreds of other variables. It's not a univariate equation. And to me, and you've heard me bleating about this in the past, I think some of our irritants that we have with respect to capital coming into the country, even outside of Iran, we would have been addressing them anyway.
Yes.
So things like, for instance, the fact that we have a source-based taxation regime in India, which is a major irritant at multiple levels for both FDI as well as FPI. I think we should be looking to move towards residence-based taxation, removing a big irritant for all major players, and therefore allowing capital to come back in. I think that's a big area of focus. There are other areas as far as FDI and FPI need to be done as well. On other matters, look, the other big debate that I would like to have is we have to recognize that interest rate markets and currency markets go together. They're intrinsically intertwined. You cannot divorce one from the other. Now, to that extent, while we see a lot of debate saying, oh, the currency market should be freer, let the currency, find its own level, I don't see an equivalent debate happening about interest rate markets, which I think see a lot more intervention than even currency markets.
Absolutely.
So this lopsided argument, I think if we allowed the interest rate markets to be a lot freer, if you reduce the level of, to use the harsh expression, financial repression, I think you will find a natural balance at multiple levels, as where capital allocation is concerned, savings is concerned, capital flows is concerned, if you allowed both markets to be equally free.
Fair point.
So I think that's something that you have to move towards. Finally, I would strongly advise against measures such as capital controls at this point in time. As I said, we should not be panicking. Even if you intend to do capital controls for a short period of time, I think the impact that it will have on sentiment in the medium term will be dramatic. I think Dr. Subbarao wrote this very nice piece in the Hindustan Times recently, where he used his own experience to warn against doing anything which sounds like capital controls. I completely echo that. While it might sound like it's the right thing to do in the short term, these things are never only have a short-term effect. Absolutely. The sentiment effect will be completely against what I'm arguing for improving the sentiment of the country.
Fair enough. Mridul, we are going to come to the interest rate debate in a bit. Mridul, I just want to ask you, don your RBI hat, not on the rate issue, but what else can we expect, or would you do if you were in the RBI today to defend the rupee?
So the first thing I would do is to sort of use soft capital flow measures. I know Anant has said that we shouldn't have capital controls, and I'm pretty conscious of that, yes. And I think there is somewhere in the middle an option to use fine capital flow measures which fall short of the total capital controls.
Such as?
And these must be backed by very good communication of structural reforms, of addressing the core issues which is driving portfolio flows away from India, be it the fiscal gap, which is people crunch the numbers and see a delayed response from the government in terms of price hikes for petrol and diesel, which seem to have opened up some sort of a fiscal hole. So you need a confidence on macroeconomic stability. You also need to take some measures forward-looking that we still have an India story. I mean, we may not have joined the AI race in time, but there is still an option to join it. We need to create some sort of positive momentum to get into the...
Oh, okay. I think you have lost Mridul for just a bit. We'll get back to Mridul in a minute. I wanted to ask you the other thing that was floating around. The Indian sovereign doesn't want to raise sovereign bonds. They've made it amply clear time and again. There was a plan that semi-sovereigns like PSU banks can be asked to raise ECBs or bonds. Doesn't that sound like a good idea? Only the hedging cost borne by a reserve bank as a subsidy?
I think the broad objective, Lata, has been to see if we can shore up dollars at short notice, maybe $60-70 billion, in order to give some confidence to the ecosystem and achieve what I was asking for, which is a little more confidence around the fate of the rupee. So I agree with that objective. I think, depreciation sometimes begets depreciation. It can become a vicious loop where negative sentiment can lead to more positioning and therefore becomes a vicious cycle. You have to arrest that cycle. We saw this in 2013, where the launch of the FCNRB scheme suddenly made a change as far as the sentiment was concerned, and that practically saw the peak on dollar rupee at that point of time, and we saw a correction thereafter. Having said that, I would again caution that the use of any kind of distortionary instruments has to be done with a lot of care and at the right time. We don't know how long this problem is going to continue for. Do you want to use all your arrows right now from the quiver, or do you want to keep something for later, particularly since all of them come at a cost, come at distortions, and you don't know what the unintended consequence can be. Having said that, compared to an FCNRB scheme which was done in 2013, I agree with you that giving a swap window where you give a subsidy for people who are raising dollars from overseas, either through loans or bonds, to swap it into rupees at a subsidized rate, given that that money will probably be deployed into capital formation and creation of new businesses, I think it sounds like of the distortionary ideas, this sounds like the better idea. And it will shore up the reserves of the RBI as well, along with capital formation.
Okay, I want to start the interest rate debate. It will pour on into the next segment. So let me start with that. Just give me your initial 1 minute comments. Mridul Sagar, do you think that at some point FIT, flexible inflation targeting, wants you to use interest rate for inflation and other steps for exchange rate? But at an extreme time when India's rupee is the worst performing currency for 2 years in a row, BOP is in deficit for 3 years in a row, should you not use rates to defend the rupee?
Lata, you asked me at the time of April policy this question, and I did mention to you that I see rate hikes later half in the year. I still stand by that. I don't think we need to jump and raise the rates. This is a classic shock, which is cost push inflation in a stagflationary environment. And you need to see a clear evidence of generalization coming in, inflation expectations coming in. The first sign of it has emerged in terms of the latest WPI numbers, where the inflation has shot up to 8.3%, and the disperse of it is pretty large. But I won't go the way Bank of Indonesia or Bank of Philippines has raised the rate.
Got it. Mridul, since we have to get into a break, Anand, first step, I'm going beyond what Mridul is answering. I'm saying it is not that inflation is on the horizon, because the Reserve Bank's scenario says that even if they accept $95 per barrel for the full year, their CPI forecast is working to only 5%. Not inflation. I'm asking you, should they use it purely to defend the rupee?
I'm going to change the question, Lata. I'm going to ask the question, what should be forget about crisis, and should you use interest rates right now for defending the rupee? That's a very extreme question. My broad point is, whether you like it or not, the three issues, which is interest rate markets, capital flows, and currency markets, are intertwined. You cannot divorce one from the other. This is the impossible trinity that we all know of, and Urjit Patel's report of 2014 also completely acknowledged it, and every economist and trader will acknowledge this as well. Now, changes in interest rates impact capital flows and currency markets, and vice versa, right? How does changes in interest rates impact? So, for instance, if the differential between Indian rates and the USD rates are too narrow, if it's only 1.5% or 2%, will foreigners come in and invest in our debt? On the contrary, will you actually see domestic high net worth individuals saying, I might as well take out my money and invest in, through the ODI route or LRS into US debt, where the differential is only 2%, which means that, I'm holding a hard currency at a pretty high rate compared to my own rupee currency, right? The second problem is, because, and I go back to my point about possible financial suppression in this country, because you've had a lot of intervention in interest rate markets, keeping the rates low. We know RBI did 8.8 lakh crores of OMO purchases. They kept the liquidity substantially high, 2 lakh crores of average liquidity surpluses, which obviously suppressed not just the overnight rates, but practically the entire yield curve, right? Now, when you have that, and you have a taxation which is against investments into debt compared to equity, what happens? You have domestic investors moving away from your interest rate markets and putting more money into the equity markets. One, it reduces the amount of money available in credit markets. It doesn't allow it to develop. Second, you have potentially too much money going into equity
overvalued
markets and creating pockets of overvaluation, which in turn impacts FDI and FPI flows. So in a very vicarious way, there is an impact there as well. The third impact, the forward rate for dollar rupee depends upon the differential between the dollar and rupee interest rates.
Anand, this will take time. I have to take a break, but I want to hear precisely this argument. The rate differential and how it plays out in the premium, forward premium market, the MY4 market, and whether at least because of that, we do need, to use interest rates. A very important part of the discussion coming up. Bazaar viewers, you will get to hear it after market hours. After a break, it's Chartbusters time for you.
Earnings-led weakness in Aurobindo Pharma on the back of a subdued show in the March quarter. US sales dropped 13%, but growth in Europe tops 30%. Management issues of possible $400 million guidance for the US business.
Mama's parent Honasa Consumers March quarter profits more than doubled to near 70 crores. Margins to expand from lows of 5% to over 10%. The company reports underlying volume growth of 30%. Brokerage is upbeat on the stock. It's up 8%.
The top drag on the Nifty, Max Health, following a subdued Q4 print. Top line misses estimates. Clinician costs spike over 200 basis points, dragging margins. Oncology share declines to 21% versus 26% same time last year.
86 lakh shares, or about 1.5% in equity, changes hands in 197 Communications, or as we know it as Paytm, in a block deal. Over, Safe Partners are the likely sellers. They own over 13% stake in the company.
Varun Beverages extends bottling pact with PepsiCo to April of 2049. Jefferies believes that an extended contract with PepsiCo will allow the company scope to explore other consumer categories. Stock trades in the green.
Morning, you're watching us here on Chartbusters. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu, with me Ekta Batra, and we're starting off with a century on the Nifty. 23,768 is where we are. The Nifty Bank is the one which is leading the index from the front. While there is some, give back on the tech index, the good part is that the Nifty Bank conquering that 54,000 mark, extremely crucial from a technical standpoint, because we do have the 50-day moving average out there, taking the Nifty above that 50-day moving average as well. The only thing that could have been a little better is the mid-cap index, Ekta.
Hi, Mangalam. Yes, absolutely. The mid-cap index is just about lower by around 68 points at this point in time. So underperforming the Nifty as well as the Bank Nifty. And the advanced decline ratio, however, is still holding in the positive terrain. So let's see whether that manages to sustain or not. So 1,984 stocks advancing to around 1,457 stocks declining on the Bombay Stock Exchange. But good time then to get in a technical check. We have Pritesh Mehta from Yes Securities joining in to tell us what he's strategizing today. Pritesh, hi, welcome to the show. Well, it's definitely a mixed session, you'd have to say, for the markets. The Bank Nifty doing better, mid-cap sulking. How would you approach trade?
Since 12th of May, markets has not done anything substantial. Index has been stuck in a range of 23,300 downside, 23,800. But I think what we observe is the improvement in internal breadth of private bank index. So this is what my focus is. In fact, we have seen this private bank index underperforming since the month of April. Now it is creating a base moving higher. So this is the one that we are watching out for. Strength in this particular basket, private bank index, then Bank Nifty, is the one trigger that is missing right now that could come into play later on. And that is the one particular index that can try to push the market higher from here on.
All right, we take that point, Pritesh. Thanks a lot for that. Meanwhile, Reliance is another one which is trying to recover from the lows. And the rupee has strengthened a fair bit to around 96.14 right now versus 96.2 as a close. Individual stocks, what are you backing right now?
I discussed about private bank index, and within the space, we like Kotak Bank. Now, see, Kotak Bank has been going through a bit of base building formation, and what we have seen is follow through a bullish anchor column. So I'm expecting a move towards 440 on the upside. The stock would be around 365. The second stock that we like is Angel One. And now this particular space, capital market index, has been outperforming Nifty. There are several stocks popping on our screen in our radar, like BAC, MCX. But Angel One is trading around the peak of December 2024. So it is knocking at the very important resistance door. Once that is taken out, we can talk about target of around 400 for the stock.
Okay, all right, Pritesh, we're going to let you go on that note. Thanks very much for joining in and bringing us all of those calls with regards to the markets. We need to take a short break on that note, but we'll be back with the management of Dr. Agarwals Healthcare to discuss their Q4 numbers. Stay tuned. Welcome back. You're still watching Chartbusters on CNBC TV18. Well, let's talk about specific companies and let's shift our focus to Dr. Agarwal's healthcare. It was a strong Q4 with robust revenue growth, healthy margins, strong traction across surgeries and patient volumes. To discuss the performance, we have with us Adil Agarwal, who's joining in. Mr. Agarwal, thank you very much for taking the time out. Well, it was a good 23% growth that you all recorded on a year-on-year basis in Q4. Just tell us how much of it was led by your mature centers, how much of it was led by your new centers.
So firstly, hi Ekta, hi Mangalam, thank you for having me on your show. We obviously had a very robust quarter, and in fact, we had a pretty robust entire FY26. If you look at our growth, what is important, one important metric that we track is the same store sales growth, which is the growth of our mature centers. And our mature centers grew around 14%. And this was led by about 7% growth in volumes and approximately 7% growth in value. What I mean by value is we have started to offer a lot of high-end, highly technologically advanced surgeries across all of our networks. And that is something which is driving a lot of the value. And another important which drives volume is obviously our new patient footfalls. And over the year, we have seen approximately 30 lakh patients across our entire network. And there we have seen approximately a 25% growth in terms of footfalls across our network. These are the two critical levers which is driving growth for us at an overall group level.
Okay. So your same-store sales growth was around 14%. Right. Just give us a sense in terms of what you are guiding for FY27, both for your mature as well as your new centers, And for your new centers, give us a sense in terms of what you are doing operationally as well.
Sure. So, Ekta, I think, the guidance which we are giving is that given we've had a fairly good year, we expect to maintain similar kind of growth rates that we have shown over the next coming 12 months. This means we will continue to grow at a similar same-store sales growth, because that is something which has been the average rate that we've been growing at for the last 3 to 4 years. But what is also going to be important is the number of new centers that we add to the network, which will bring in the remaining growth. We are looking at adding 60 new centers to our entire network over the next 12 months. Out of these 60 new centers, 40 will be premium surgical centers, and we're looking at adding 20 clinics in smaller micro markets. So I think a combination of growth in your mature facilities, at the same time, a robust adding of your footprint of your surgical facilities is going to be very important for us to keep up this growth.
Oh, that'll be an interesting one, because in the last 4 years you've added about 148 centers, and in the next 12 months itself you're targeting around 60. So in the very near term, obviously there could be a bit of a drag on your return ratios. I just wanted to understand how will the operating leverage on these new centers pan out over the next, say, 3 to 4 years. The next year, obviously, you've given us a target of 14% same-store sales growth. The last year you did a revenue of 21% in terms of growth, with margins around 27%. Assuming that sustains, over the next 3 to 4 years, what's your aspiration? What's the target? Do you have a milestone number here, Adil?
So we are hoping to keep up with the similar growth rate that we have shown over the last 2 to 3 years, over the next 4 years. I think that kind of a sustained growth rate will significantly compound over the next 3 to 4 years. Many of the building blocks for some of this has been laid out in the last few years in terms of us building out the teams, us training doctors, having the right kind of centers located across many of these larger markets. An interesting thing which we've done over the last 12 months, Mangalam, is we have actually entered the Delhi market, which is fairly large in size. So we have actually opened 6 new centers in Delhi, and we've barely touched the surface. So I think Delhi NCR and Haryana expansion over the next 3 to 4 years will be a very important lever for us in terms of how we expand the retail footprint of our network.
So just to back calculate those numbers, the last 3 years, your revenue is compounded by about 27%. Your current revenue at around 2,100 crore rupees. If that continues over the next 3 to 4 years, you are looking at numbers not very far away from 4,500 to 5,000 crores. Is that on the anvil?
Everything is, we're hoping that as long as we don't run into any significant headwinds, we should be able to at least maintain the growth rate that we've maintained over the last 12 months, at least, Mangalam. Anything beyond that will obviously be icing on the cake. But we're hopeful that, our teams continue to do great work. Our doctors are doing great work across all the centers. And we are able to provide quality clinical outcomes to all our patients. So hopefully things go well for us.
Okay. Just wanted to understand, and this might not be a question which would be related to your quarterly numbers, but you are opening, say, for example, 6 centers in Delhi. And Delhi is a market which is extremely saturated in terms of hospitals as well, and in terms of bed additions which are coming through within that space. In that sense, are you seeing any kind of formidable competition come through from multi-speciality hospitals which are vying for that same revenue share as you in Optal?
So, Ekta, what is interesting about our business model is it is very different from a multi-speciality hospital. We are very focused only in terms of doing daycare surgeries. Typically, if you look at many of the multi-speciality hospitals, the percentage of revenue coming in from the eye care business is very minuscule. So our business model is completely different. We operate more as a retail outlet. We focus on daycare surgeries. Patients walk in, get surgeries done, and leave within 1 hour. So the business model is completely different. We have typically not seen multi-speciality hospitals compete with us from that perspective.
Okay. But would you consider running the Optal clinics for multi-speciality hospitals within their hospitals? Is that something you already do, or is that something that you would consider?
We do it in a few places, Ekta. For example, in Calcutta, we have a hospital where we run the eye department. But typically, the multi-specialty hospitals are fairly well equipped themselves that, they don't need us to run their hospitals. Given a chance, we are open to it, for sure.
Right. What about the payer mix? Since it's, go in a day, come out, I don't know, what's the kind of insurance payer mix that you get out here? And if it was an overnight stay and insurers, the insured were allowed to avail benefits of that, do you think that would change your metrics?
So if you look at our current payer mix, Manglam, approximately 63% is cash, and about 25 to 27% comes in from insurance and TPA. About 8 to 9% comes in from government payers. This trend, what we're seeing over the last few years, is the actual contribution from insurance and TPA is slowly increasing. But if you compare us to the multi-specialty hospitals, they have a much higher percentage coming in from insurance and TPAs. The reason why the cash contribution from us is still higher is many of the procedures people still pay out of pocket. We have a retail arm, which is where we sell glasses and lenses, similar to what Lenskart does. That contributes to 13% of revenues. All these are revenue streams where people actually pay out of pocket, and insurance doesn't cover some of these payments.
Okay. All right. Mr. Agarwal, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So the stock is at just about 480 odd rupees, down around 0.2%. We need to now shift focus to our special segment where we will now get you a few ideas for profit from Moneycontrol Pro. Lekha Jamnani of moneycontrol.com joins in to talk about a stock that she's tracking very closely. Lekha, over to you.
Yeah, so my stock pick is Vijaya Diagnostics, which delivered an outstanding Q4 FY26 earnings, reaffirming its position as one of India's best-run diagnostic companies with industry-leading margins, disciplined expansion, and strong operating leverage. Its revenue grew 27% YOY to 219 crore, while EBITDA saw 39% with margins of 43.6%, the highest level seen in recent years. Our growth was driven by robust test volume, improving realization and successful geographic expansion into Pune and Gurugram through the Medinova acquisition. The company continues to benefit from structural tailwinds in preventive healthcare, wellness testing, and a shift towards organized diagnostic chains. Its new centers achieved a break-even within 2 quarters, highlighting Vijaya's strong execution and ability to scale without sacrificing profitability. Management plans to accelerate expansion in FY27 with 4 to 5 new hub labs and 10 to 12 spoke centers across key markets while maintaining double-digit revenue growth and EBITDA margins around 40%. Its investments in AI-driven diagnostics, automation, and its entry into genomics are expected to enhance efficiency, turnaround times, and revenue per test. With a debt-light balance sheet, strong cash flows, and a proven track record of disciplined capital allocation, Vijaya remains well positioned for long-term earnings compounding. Trading at 27 times FY28 estimated EV/EBITDA in line with this historical average, the stock offers an attractive opportunity to participate in India's fast-growing diagnostic sector.
All right, with that, we'll take a short break, come back any more of the markets, a lot of stock-specific action. Keep it with Chartbusters.
Welcome back. You're still tuned into Chart Busters this Friday morning. Well, the mid-cap index, like we've been pointing out, has been sluggish. So it's down around 68 odd points. But just watch out for a couple of stocks. Say, for example, a Lakshmi Dental, which has spiked up around 20 odd percent. So that stock is doing very well in today's trading session. We also have a couple of other stocks such as Spark, which has done extremely well post its numbers. So that stock has now gained around 14% this week. But Honasa Consumer is surging after what was a good set of fourth quarter numbers. Manglam, tell us more about it.
Well, the operating leverage is finally beginning to show. And for all these new age companies, it seems like they're coming off age. For Honasa, after 18 months of, a problem with regards to their go-to-market strategy in the offline space, etc., things seem to be coming together. Let's see how that goes. The revenues grew by about 23%. The adjusted revenues for, the Flipkart business is actually a 28% revenue growth. And they've reported their highest ever EBITDA ever since they've listed. In fact, it's 77 crores. This compares with about 27 crores. So that's an over 180% jump. Margins have come in at 11.5% versus 5%. And the net profit on that 25 crore turns into 60 crores as well. Looking at all of this, the company has gone ahead and, announced their maiden dividend of 3 rupees per share as well. Ad spends, which were 34%, have come down to 32.9%, and other expenses, which were about 22.5% of sales, come down to 14.8%. So that explains the operating leverage play out here. The underlying volume growth has been 30%. Importantly, Mamaearth, which is their mainstay business, that's grown in teens. The important part is the younger brands, which are the newer brands of the company, which are diversifying away from the mainstay, have grown over 40%. And some of them have actually turned EBITDA positive as well. So all these factors doing well for them. Let's see where it goes from here on. The stock up 6% right now. But over the last, years or so, if you look at it from the post-listing high of upwards of 500 rupees, it's still a fair distance away. And it was only very recently that it crossed its IPO issue price of 324 as well. So at higher levels, do we see some sellers or do we see more interest coming by? It will be the important part.
Okay, that's on Honasa, but Nykaa.
I said, these new age companies coming of age. Nykaa, it's flawless beauty. That's what Brokerage Note has said. And I'll borrow from there because the net profit has grown 4 times. It's crossed the 10,000 crore revenue milestone for the full year. It's strong performance in the beauty business, the fashion business, where the company has been speaking about losses reducing. That has come by as well. And the net profit from 19 crores has turned all the way up to 78 crores. Look at their segments. The beauty business, margins have increased from 5.5% to 6.6% with a revenue growth of 27%. Fashion, revenues grew 40%. The EBITDA loss, that actually has narrowed from 36 crores to about 8 crores. And their own brands have done well this year. E-Superstore business, which is their wholesale business, that too has done extremely well. Again, the problem with Nykaa is at higher levels, we do keep seeing sellers in the stock. This stock too, post its listing, adjusted for bonus, has a high of over 431 rupees. After having rallied from the lows, still a fair distance away from there at 275. And at higher levels, we keep seeing sellers in Nykaa.
Okay, so that's on Nykaa. But I'm looking at Aurobindo Pharma, which is under pressure in today's trading session. That is after the Q4 numbers that were released. So the revenue growth was around 5.6% this quarter. It was better than expectations of around a 4% growth. It also came out with margins of around 19.2% versus expectations of close to 20 odd percent. And even the profit grew around 2 odd percent. And the street was anticipating just about 916 crores in terms of profits. So it's done better on all of the parameters. But what obviously weighed down on the stock was that the US was down 13%, and that's expectedly so because there was more competition in key drugs such as Revlimid generic, which most companies saw this quarter. Europe did well for them. It was up 30% on a year-on-year basis, but on a constant currency basis, $261 million, it was flat sequentially. Growth markets did well. It was up 25% for Aurobindo. In terms of a key conference call takeaway, they see EBITDA margins improving to over 21% in FY27. $400 million is a reasonable base assumption for the US business. They did around $387 million in Q4. They may see US formulations revenue at $2 billion in a couple of years. Europe, companies looking at double-digit growth in constant currency. They're looking at licensing opportunities in Aurobindo, but when it comes to acquisitions, they're currently focusing on the Lanet acquisition and the integration of that. Remember that the stock already went into its numbers at a 52-week high. It hit around 1,550 odd rupees, which was a fresh 52-week high for the company, and it's gained around 24% in the past 6 months. So there is some amount of profit booking in what is a largely operationally in-line quarter and a working quarter for Aurobindo.
All right, Ekta. Thanks a lot for that. So that's about Aurobindo Pharma at the low point of today's trading session. Also at the low point of today's trading session so far has been Bharti Airtel, ONGC and PB Fintech. ITC reported its numbers yesterday, still finding no buyers right now because the street still is drawing out the uncertainty that is ahead of ITC with regards to volume. So let's see where that goes. But out of time on this edition of Chartbusters, the Nifty up 125 points, the Nifty Bank doing the heavy lifting. We take your leave from Ekta Me. Thank you so much for watching. The team of Trading Hour comes up with the market action after this short break.
Good morning, you're with us here on Trading Hour. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormas Patakia, and since it's Friday, Ritu Singh is joining with us here in Bombay. Ritu, good morning. Well,
good morning, Hormas.
It's been a very, it's been a very volatile week. But coming into today's session, the Nifty had gained a precious 11 points for the week.
11 points.
Precious 11 points. But then, of course, it's a good start today. We are back at the higher end of the range as of now, at that 23,300 to 23,800. But we are now at the highest point of the day, 125 points higher, still continuing to hold on.
Weakness in trade earlier, but now it's seeing some gains, about 92 points higher on the IT pack as well. The advanced decline ratio tells you that almost 1.5 stocks are advancing. That's 17, 80 stocks are advancing for the rest of the stocks that are declining on the National Stock Exchange. So the market setup looks good today. In terms of sectorally, what's doing well apart from the banking pack is the metal pack, the auto pack, even the IT pack now back in the green. But what's dragging the market slower is a pharma pack, realty and energy. But let's, as always, go across to Hormas to put a spotlight on the top movers in trade.
And the bulls would definitely be hoping that we at least manage to end at the highest point of the day, if not more, because as has been the trend over the last 6 sessions, the index has been managing to test both the lower end and the higher end of the range, but is only managing to close between the 23,600 and the 23,700 zone. So at least the bulls would hope that this level at least sustains if we don't manage to cross 23,800 as well. But the Nifty Bank is the one, as Ritu highlighted, that's doing the heavy lifting today. And just like the Nifty Bank is also trading both the lower and the higher end of its range. It is 53,000 to 54,000. Right now it's at the higher end of the range at 54,000. It made an intraday low of somewhere close to 53,500 today, and since then has continued to move higher. And it is the heavyweight banks that are putting their hand up today, or HDFC Bank, ICICI Bank, gains of anywhere between 1 to 2%, Kotak Bank too. Axis Bank is the outperformer here, 2% higher now on the stock. But earnings reactions today are more predominantly on the negative side more than the positive ones. Engineers India is, well, off the high of the lows of the day. At one point the stock was down around 10%. Max Healthcare though is the top index loser today, 6% lower. Sun TV down a similar quantum, and Arvind Pharma, after its earnings call, is down 6% as well. You take a look at some more earnings reactions today. They too are on the negative side, barring Honasa Consumer. That stock is up 5.5%. Is doing well from jumping past its issue price now. They're 380 on the stock. Welspun Corp and LG Electronics. LG Electronics is now down well over 15% from its listing price, which was over 1,700 rupees. There were a slew of block deals that took place earlier in the day before market open, and JSW Cement was one such name. It reported results yesterday. The stock did well, and now it's extending those gains after the block deal, 9% higher now. Paytm is seeing a negative reaction after the block deal, 4% lower, and Pine Labs not significant because the stock has already corrected a lot from its issue price, which is well over 220 rupees. The newsmakers in today's session, Central Bank of India, well, the OFS has opened for non-retail today, 5% lower on the stock. MTAR Tech now well over 200% higher for 2026, another order win for the stock, another order win for VA Tech Wabag as well. And lastly, stocks at 52-week highs in today's session. Sandhar Tech, D Development, both of them reported results yesterday, and Triveni Turbine too, 3.5% higher at a 52-week high.
All right, Hormas, thanks very much for running us through that list as always. Max Health is the top Nifty loser today. That follows a subdued fourth quarter print. The top line missed what the street was estimating. The clinician costs spiked over 200 basis points that dragged the margins. So let's go across to Ekta Batra for the fine print of these earnings. Ekta.
Well, yes, definitely a subdued quarter, which is coming from Max Health. Revenue was up around 10-odd%. Street was anticipating around 14% growth. Margins came in under pressure on a year-on-year basis, but it was better than at least what the street was anticipating at around 25%. And profit was just about higher by around 3-odd%. Street was anticipating over 415-odd crores in terms of profits. Now, the share of oncology has dropped this quarter to 21% from 26% and 24% sequentially due to the discontinuation of select chemo drugs for institutional patients. This is something that took place last quarter as well, so it's extended into this quarter. The margins were lower because clinician costs have risen around 230 basis points year-on-year. EBITDA per bed improved on a year-on-year basis, or rather on a Q-on-Q basis, but it was flattish year-on-year. Other segments did well. So Max Labs were up around 14%. We had Max Home, which was up around 30-odd% in terms of revenue as well. Overall, this was the performance for the company this time. The street seemed to be a little disappointed in terms of the revenue as well as the margin performance.
Ekta, thank you for that update there. Max Health, as we just highlighted, the top loser on the index today, 6% lower on the stock. Now, the big event to watch today, though, is the RBI board meeting to decide on the surplus transfer to the government for FY26. Now, Ritu has hopped over to the other wall, and she's here to tell us all the important highlights from that. Ritu.
Well, the street is pegging the FY26 surplus transfer at around 3 lakh crore rupees, with estimates that range anywhere between 2.7 lakh crores all the way to 3.6 lakh crore rupees. And if that happens, it could mark yet another year of extraordinarily large payouts from the central bank to the government. Now, the trend has already been striking. If you look at it, from just over 30,000 crores in FY22, the RBI surplus transfer has increased each year since to hit a record 2.68 lakh crores for FY25. So what is going to drive this massive transfer this time around? Of course, the RBI's earning profile has strengthened significantly through FY26. The bank benefited from gains on foreign exchange interventions, higher returns on its large foreign asset holdings, elevated global bond yields through much of FY26 also boosted the income on RBI's forex reserves, while higher interest income from government security holdings, all of that would have added to the surplus. Now, a quick explainer on how the dividend math actually works. The RBI earns its money from one forex reserves, of course, the government bond holdings, dollar sales, the liquidity operations, and from that, then it deducts the expenses which are relatively smaller, such as currency printing, operational cost, the staff expenses, and monetary, operation costs. But before transferring the remaining surplus to the government, what RBI does is set aside money as a safety buffer, which we call the contingency risk buffer, or CRB. In simple terms, RBI surplus equals income minus expenses minus the risk provisions or buffers. And the CRB, that is the key variable that markets look at, because under RBI's economic capital framework, this CRB can range between 4.5% to 7.5% of RBI's total balance sheet. The higher the CRB, of course, the lower the payout to the government, and the lower the CRB, the higher the surplus transfer. Now, last year, RBI had set the CRB at 7.5%, which is at the upper end of the range, and it still delivered a record payout. So the markets will now watch whether that continues, with a conservative buffer, or RBI is able to release more surplus to the government this year. And that payout matters immensely for the government's finances. For FY27, the government has budgeted about 3.16 lakh crores, and this is combined dividends from RBI, from all the PSU banks and financial institutions. Now, the RBI transfer itself has become very critical as a source of non-tax revenue for the government. It improves the cash balances of the government, it helps contain the borrowing pressure, and it, of course, creates more fiscal space for capex and for spending. Now, in FY25, for instance, the RBI dividend accounted for about half of the government's total non-tax revenue. So a large RBI payout, therefore, does more than just boost the coffers, an important number that the markets, economists, investors, all of them watch very keenly.
We'll all be watching for that very keenly as well. Of course, I stand corrected. This was not the highlights, they were the expectations from the RBI board meeting today. Ritu, thank you for that. In fact, the currency has now appreciated past the mark of 96. So it's the fourth day after 4 days is the rupee is now below 96 against the dollar, and it's now appreciated nearly 1% from that record low of 96.96 that it had declined to on the 20th of this month. To take a short break, on the other side, we're back with the management of Nucleus Software to talk about their fourth quarter results and the road ahead. Stay tuned. continue to remain at that 23,750 mark on the index, but the currency is the talking point right now. 95.97 is where we are. So almost 1% is what the appreciation of the currency is.
Yeah.
But of course, there are some names that are continuing to not do very well. Aurobindo Pharma has extended its losses now, is down around 5%. Wellspun Living is down a similar quantum. Glenmark is down a similar quantum as well. And Paytm, of course, after the block deal, not doing very well. Of course, there are some names that are doing very well, though. Dixon Technologies has moved to the highs of the day, 5% higher on that stock. So that continues to do very well for itself. Astral, after its results, is recovering some of those losses, 4% higher here as well. And new age names like Meesho. So of the new age companies doing well, Meesho has also put its hand up as well, Ritu.
There are other new age companies. You also have Pine Labs that has jumped up in the last hour of trade. In fact, if you pull that up, it's up almost more than 2% now. A lot of that gain coming in just in the last hour. Godrej Industries is another stock that is doing pretty well. Jindal Saw, Action Construction, Concord Biotech, AB Capital as well after that fundraise. So yeah, these stocks are doing relatively better in the last hour of trade. So let's see if we can go across to Manisha now to get a check on what's happening in the bond markets always, or the commodity space this time around. Manisha, always an interesting space to track.
Well, yes, commodities or bonds, both of them. But we're talking about copper right now because we've seen prices continue to gain, even as most other commodities are closing this week slightly into the negative. Not the case clearly for metal prices. Aluminum is trading higher, and so is the case with copper. So on the week, we are 2% up for copper. For this month, it's 4.5% off again. And for the year till time, it's 11.5% up. If you look at the last 12 months, more than 30% up is how the copper has been. Various reasons for that, really. The prices are trading very close to its all-time highs. One, it is about mine disruptions in various major producing countries like Peru or Chile, for that matter. The long lead times, it takes 17 years for a mine to be started to be discovered and till the production comes in. So that's another thing that continues to support copper prices. And in the last 20 years, no new mine has been found. And then you have declining iron ore grades, the reason that you have seen miners go further down into the earth, and that increases cost and, of course, decreases cost efficiency. It also is about sulfur shortages that we have seen because of the West Asia conflict, the smelter pressures, the AI boom, the EV, the renewables, all of that is where copper is used. And we are looking at supply constraints, but the demand has been on the positive side, supporting the prices therein. So when you look at the price forecast for copper going forward, it mostly is for the higher side. The first quarter of this year has seen all-time high in case of copper at around $14,800 a ton. And that's exactly where the markets believe you could be looking at copper prices yet again. Trading Economics puts copper to $14,000 to $15,500 a ton for this year. You have UBS suggesting that $13,200 is an average we could be looking at. JP Morgan puts it lower to $11,200. And Codelco for that matter, says $12,000 a ton is where we could be looking at prices averaging so much on the higher side continuing for this year as well.
All right, Manisha, thanks very much for bringing us that update. We'll slip into a short break with that. But up next, we're going to talk more on the market, so stay tuned. Welcome back. You're still tuned into Trading Hour. The market's holding on to those gains. 23,760 is where we're at. Let's see if we can, perhaps get to that 23,000 or 2,400 mark. I mean, that's the next key one to watch out for. Bit of a recovery again in IT. It's going up if you pull up some of those stocks, lending support to the Frontline index as well. Names like ITC, of course, Maxell, Bharti, these are on the downside, but the banking names are doing well. IT is picking up as well. Reliance, the heavyweight, alone adding, quite significantly to the Nifty as well. But Hormaz, the broader markets, they also seem to be doing better than some of the volatility we've seen through last week.
The broader markets have been fairly okay compared to the index. The index has continued to meander in a range, but of course the broader markets also, because of the fact that there is significant stock-specific activity that is taking place there. Now look at HFCL and the stock that is already up 100% this year. That's adding another 3% in today's session. And Keynes Tech is seeing some recovery from 52-week lows. That's up another 3% today. But of course, you have to mind the fact that the stock is in the F&O ban. So no new positions here on this.
But also, look at the rupee. It's gone below 96 now. I think psychologically that's a good level. And, all of yesterday when we were seeing that fast slip towards 96 and then 97, there was a lot of intervention from RBI. Finally, it was not on the fringes. There was quite a bit of intervention from RBI. And now you're seeing rupee actually make some recovery. 95.99 is where we're at, with crude prices also seeing some improvement. Mangalam Malu joins us now to bring us the latest trends from the F&O space now. Mangalam, over to you.
Well, since you guys have been speaking about the market, it's been recovery. It's on a recovery mode. Let's see whether the Nifty does cross past this current congestion that we're seeing between 23,750 to 23,850 or thereabouts or not. The good part is that the Nifty Bank is playing a fairly decent knockout here. Mid-cap index not participating in terms of the gains that have come by, but the advanced decline tells you that far more number of stocks are on the green side as against the red one. It's a large part of that has to be attributed to the macros. You guys have been speaking about the rupee strengthening past that 96 mark. Look at oil. That too is contained at around 105, sub below $105 per barrel. The Nifty faces some technical resistance right now, and that's the only concern. It's above the 50-day moving average of 23,705. It needs to close above that, point number one. And if it does close above that, then the next level to track will be the 23,900 mark, which is the 20-day moving average. So all said and done, despite today's up move, are we out of the woods? Perhaps not. This 23,700 to 23,900 zone still remains a bit of resistance. The Nifty Bank, which itself is powering the Nifty ahead today, around that 54,630 mark and 54,700. So between 54,600 to 54,700, we have both the 50 and the 20-day moving average. So while it's moved higher, has it gone past those congestion zones yet? Perhaps not. So which is why those option writers are fairly skittish on the upside for the Frontline index as well. So the good part is that put writers are active. They tell you that the base of the market has moved higher. 23,700 put and the 23,750 put. Both of them tell you that between 23,500 to 23,600, now we will see some support. So that's moved higher from 23,300 and 23,400. So about 100, 200 points is where the support has moved higher. The congestion still remains, which is why 23,800 call writers are fairly active, playing for some supply coming in around that 23,900 to 24,000 mark itself. But a lot of stocks are caught on the wrong side when it comes to shorts. So Dixon, Keynes Tech in particular, doing well in today's trading session with a lot of shorts unwinding their positions. If stocks are something to go by, and if the Nifty manages to cross past the current congestion, then a lot of the shorts which are present in the Nifty as well will have to cover their positions, and that will lead to a bit of a melt up. But for that, the macros have to change.
Indeed, the bulls would be hoping for that. Mangalam, thank you for setting that up from the F&O desk. Shifting focus now to corporate conversations. Then Nucleus Software reported their first decline in top-line growth since the second quarter of FY25. Overall, the results were a miss. Profits were down, EBITDA was down as well. And the company closed the year with profits of under 120 crore compared to 160 crores that it reported in FY25. Let's discuss the numbers and what lies ahead with the CFO, Ashok Kumar Bhura, who's now joining in. Ashok, good morning. Thank you for taking time out. There was a revenue growth of 5.3% for the full year, but there was some pressure on your margins. So let's get two numbers out of the way straight away. What is the kind of revenue growth that you're penciling in for FY27, and the pressure that you have seen on margins, does that recover in FY27? What are the kind of margins that you are anticipating as well?
So, as a policy, we don't give any forward-looking statement. So, I will not be able to divulge on the numbers which are looking in FY27. However, I can share what we are doing, and what we can decipher out of that, and indicatively I'll share what we are doing on this. If we talk about margins structurally, there is no issue. It is more of the regulatory thing or the legal thing related to labor law which has come up and has impacted PL, which is true for the industry as well. A lot of industries you will see got impacted because of this new labor. And that is what is impacting us also in some fashion. However, if I talk about structural margin thing, there is no such problem. We are sitting on good order book. It is robust. And if we talk about new logos which we garnered in 25-26, we have garnered few good logos in FY 25-26, much better than what we did in 24-20.
But Ashok, what's the number? With these good logos, the good order book, what is the FY27 guidance, both on the margins and the revenue?
So we will not be able to give future-looking guidance. I am sharing what, as a company, we are doing fundamentally. We continue to invest in AI-ready products and enhancing our capability on AI and AI talent. So that is what we are looking at, because a lot of our customers are looking for AI innovations and addition in the products, and we want to be ahead of the curve, and that is where we are investing. So in short term, you might see some pressures on margin because of this, but however, in the long run, definitely that will pay off.
Okay, you may not want to give us a number, Ashok, but will FY27's revenue growth be better than what FY26 was?
We are sitting on a robust order book, which is almost 50% better than the previous years, and hopefully that should play out in coming years, and we look forward to a positive outlook.
Ashok, could you spell out what the order book is now, and the growth in the product and business services as well, what that's like?
So, if I talk about our closing order book, it will be in the tune of above 1,000 crores.
Okay,
which,
above 1,000.
If I talk about the similar number last year, it was somewhere around 630, 640.
And just a quick clarification, since you said, it was the labor cost that played out, in your numbers for the quarter. Are you expected to take a further hit in the coming quarters? Has it fully been absorbed, or what would you be able to guide this street?
It is fully absorbed, and there is nothing in addition which we are looking at in coming quarters because of that.
Ashok, the last time the management had flagged off the fact that there are elongated deal cycles that are taking place, and they had flagged that off as a headwind for the company. Now, those delayed deals, out of those, has any of them moved towards signing in the fourth quarter? Have you signed any of those deals? And does this decision-making cycle still continue to remain elongated even in this quarter?
Yeah, it is continue to remain because a very niche segment product, and it takes a lot of time for any company to decide. And even if any customer wants to move out, it is difficult for them also to move out because of lot of impact on their customer. And that is why it takes a little longer time. In quarter 4, we have been able to fructify quite a few deals out of that, which we were discussing in the last year. And that is where I am saying our order book looks robust, and that is getting reflected in our closing order, which is much heavier than the previous year.
Got that, but could you give us a sense of, how elongated are deal cycles actually getting? I think from some of your con call takeaways, you were saying the deal conversion cycles are as long as 8 to 18 months. Is it getting any better? Is it getting any shorter? Any clear, clarity on this?
So while I can't divulge the name of the customer, but we have been able to close deal even 6 weeks as well.
Okay.
So it depends on customer to customer and how big they are. Like say, for example, if any customer is a greenfield customer, then obviously it takes a smaller cycle. But if a customer is already sitting on a heavy loan book, then obviously it takes a little more time to decide and close.
Right. Ashok, pleasure having you today. A bit of an audio issue with you, but thank you for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management of Nucleus Software, the stock not doing very well today, 5% lower now as we speak, nearing the lowest point of the day. Take a short break, continue our conversation on the markets with George Joseph from ASK Investment Managers. Welcome back. Well, a lot of these broader market names now are extending their gains. Elecon Engineering is one of them, 5.5% higher on that stock as well. And Honasa Consumer is now up 7%, and that is at a 52-week high. Just 60 rupees above its issue price, but is at a 52-week high. The other big news announcement that came in was with regards to Dalmia Bharat and its deal with certain cement assets of Jayaprakash Associates that is going to acquire from the Adani Group. Sudarshan is here with the fine print of that. Sudarshan.
So finally, Dalmia Bharat has got what it was trying for a long time. They had tried earlier also, but this time they are getting part assets of JP Associates. So 4 plants total. One of them is in Madhya Pradesh and remaining 3 are in Uttar Pradesh. And deal value is done at $67 per ton and enterprise value is 2,850 crore rupees. Financing, it will be done via debt and internal accruals, and transaction is expected to be completed within 2 weeks. So what all Dalmia Bharat will get? Cement capacity of 5.2 million tons per annum, clinker capacity of 3.3 million tons per annum, and thermal power capacity of 99 megawatts. These things they are going to get from JP Associates deal. Now, why it is good for Dalmia Bharat? So it will give them access to central markets and makes them a pan-India player, pan-India cement company like other companies, Ultratech or say to an extent Shree Cement. And this will take total capacity to as high as 66.7 million tons per annum, and that would happen by Q3 or Q2 of FY28. So overall, it's looking good, and that's the reason the stock is also reacting positively.
All right, Sudarshan, thanks very much for bringing us that update. Let's now go across to Joseph from ASK Investment Managers, who's joining us now to discuss market fundamentals and his top sectoral picks. George, thanks very much for your time here, since our colleague was just talking about the cement space. Any thoughts there? I think you're overweight on the construction space overall. Do you see further upside for cement company margins, and any thoughts on this Dalmia JP deal that's been announced?
So if you look at what we have been telling our investors last whole year is that we are in a cyclical rally which started in 2020, and that continues. Energy crisis has only increased our belief that the inflationary trade which started in 2020 is going to continue. So cement sector also is part of the cyclical sector, but nevertheless, the energy crisis which has been created by the Strait of Hormuz issues and all those things has only put more pressure on the margins, because cement sector as such is a highly power intensive sector. So we are constructive on the overall cyclical sectors, be it engineering, capital goods, cement, auto, and also banking and financial services, along with commodities. So that is a pack which we like. Now we started liking the IT sector as well.
Oh, that's interesting. You started to like the IT sector. What drives your optimism on this, George? Because the situation on ground has not changed materially, barring the fact that the stocks have corrected significantly and there is some valuation comfort for this. You'd want to know what's driving this optimism for you on IT.
Yeah, interestingly, as a fund manager, I have been trained over the last 25 years to focus on cash flows and valuations. And what the market does later on is all, not in my hands. So when I look at from that perspective, fundamentals, valuations, and also the structure at which, the sector is poised, there are a lot of negativities around, the Anthropic announcement, and because of which the stocks have corrected. As you rightly mentioned, nothing has changed on ground. The companies are delivering results as usual. There was a lot of expectation saying that the companies will not exist going forward. We are of the opinion that these are all IT services companies. Technologies are under disruption, and Indian companies are nowhere near in the technology space. They have technology services companies which handhold companies to improve their technology offerings, and that's where all the technology capability in various enterprises, consulting as well as handholding is something done by our Indian companies. And there is not going to be material difference in the whole scheme of things. As technology is used more and more, you also agree that the services revenues actually has to go up. So on one side, people are worried about the technology services companies, their repetitive jobs will go away, and so on and so forth. But at the same time, you will agree that the valuations are really undemanding, with the concerns emerging, and the growth prospects from the AI-led revenues. AI-led transformation is definitely on cards, and that is something as a new business which will come for these companies. But AI-led revenues, no visibility is there. That's where the whole concerns are at this point. And so when you get these concerns for high-quality businesses like IT sector, strong cash flows, valuations, we have turned positive, and we have been upping the investments in those space.
I just had a follow-up to this, George. A doomsday scenario aside, but there have been updates that Anthropic and all of the other AI companies have been putting out, which do a lot of things that the Indian IT companies are already doing. The SaaS bit, yes. And so are you trying to say that valuations and cash flows are the only reasons why you've turned positive? And if you have, where within this have you turned positive? Are it the large cap IT names, which are the services solutions providers, or within the ER&D space, and so on? Where are you increasing your allocation within IT?
Predominantly the large cap ones, because they have the capability of investing into the newer set of requirements the clients have. And having said that, the point which you're making is very interesting. So most of these technologies providers, be it Claude or all of these companies, they can't be system integrators. So nowhere in history it has happened that way, that mainframes came in. IBM mainframes came in. The companies of Indian context, the IT services companies were the ones which will implement and do the system integration for enterprises. So that will continue for these as well. They will try out, the technology providers, they want to get a feel of it, how it will get implemented. They will try out some of the services related aspects, and then, they will engage with Indian IT services companies or IT services companies in general to provide these solutions and take it to the enterprises. Enterprises are very, very complex.
Yeah, George. Just very quickly, since we're running out of time, these specific names that you've exited, Bharti Airtel, Titan, Bajaj Finance, Samvardhana, Motherson, these have done well recently. Any particular reason? I mean, is there no valuation comfort here, no upside you see?
The markets have been changing, and at ASK, we are running very, very concentrated portfolios in the PMS and alternate investment fund basket. So the choices are made in such a way that where we see the valuation comfort is very high, the growth prospects are reasonable, and also we are not paying through the roof for various aspects. So margin of safety, fundamentals, opportunities at scale, all these things, when we look at from that context, it looks, the 20 stocks, what we identify will be always have some room for addition and deletion. Yeah. And it doesn't mean that we are negative on the telecom space or something like that, but we see some other better opportunities in place in the context of markets correction.
All right, George, we'll leave it at that. Thanks very much for your time here today. We appreciate it. And on that note, we'll also slip into a short break. But when we're back, we're going to be back with the Wakefit management to discuss their fourth quarter numbers with Chaitanya Ramalinge Gowda. Well, let's shift focus to Wakefit Innovations. It was a strong fourth quarter with sharp improvement in margins and a swing to profitability that was driven by robust growth in mattresses and retail. Let's get the performance and the outlook risks with the co-founder and executive director, Chaitanya Ramalingegowda. Chaitanya, always a pleasure to have you and good to see you here. Now that you've swung to profitability, start by telling us how sustainable that is and any guidance you could give us on the numbers for FY27, the top line and the bottom line.
Sure. Nice to be here. Thank you. So like I've always mentioned, Wakefit has been a largely profitable company in the last 11 years of our existence, except for the 2 years when we went into the greenfield project of setting up one of India's largest furniture factories. So we've been profitable even in the run up to the IPO. But what is now sustained is that we've also turned PAT positive once more, and we will be on that journey continuing. But in terms of where we are and the projections for the coming year, the two major things that are impacting how we think about it is because of the inflationary environment, will consumers continue to invest the same amount in discretionary products like ours? And second one is, as the price increases happen because of the raw material prices going up anywhere between 30 to 60%, 30 to 80% over the last 3 months, will that sustain or not? How much of it we should absorb as a company and how much we should pass it on to end consumers, that's a fine line that we are treading. So between these two, despite these two, we are still aspiring for a growth number of more than 20%, but we should see where we land up despite our best efforts.
Chaitanya, since you answered what we were going to ask you, you may as well answer that as well. What are you observing on ground with regards to what you just highlighted, right? The input cost inflation that you are seeing, how much of it is impacting you as a business? Have you undertaken price increases? And if you have, by how much? And what has been the consumer response to all of this, the rising inflationary impact and any potential price hikes that you've taken?
Sure. So the price hikes, we took one measured price hike in March and another measured price hike in April, both of which anywhere between 4 to 8% for different SKUs, averaging about 5 to 6% aggregate each of the hikes. But it was not done just by us. Pretty much the whole industry has taken, in the organized segment at least, has taken very specific measured price hikes to the similar quantity. The good thing is that we have always been buying raw materials when the prices are low. These are not perishable raw materials, so we are enjoying some of the benefits temporarily. But if the crisis extends for a few more months, then we will also end up seeing that impact in our margin. But having said that, given that we are a multi-channel and multi-category company, which means our website and our COCO stores are the most profitable. Our COCO stores have nearly double the average order value of the online. So we are able to find some balance to try and mitigate the impact of the risk.
Chaitanya, we've been asking you this question for the last few quarters and we're seeing the revenue mix also increase when it comes to furniture. That's a high margin business for you, a focus area for you. Now it's almost a third of your total revenues. How much further do you expect it to go from here? How is this mix evolving quarter on quarter?
I think quarter on quarter would probably be a very short-term view to take because specific sale events, specific festivals, etc. might move things up and down. But over the next 4 to 5 years, we do think that furniture can go up to nearly 40% because that is a very large, unaddressed, unorganized, fragmented market. And we have very, very good founding blocks in terms of research and development, large facility, supply chain, our own, that will enable us to continue to grow there.
What about same-store sales, Chaitanya? What were they like in the fourth quarter? And if you could say what you closed out the full year with and what are you aiming for in FY27 considering all the headwinds that we are facing currently?
So in terms of retail growth, we have delivered about 49% growth FY26 versus FY25 the whole year. That means it is firing very, very well. Depending on the different months, same-store sales growth has hovered anywhere between late teens to mid 20s. That's also because our store network is relatively new and we only have about 139 stores as of 31st March. As it scales up, it might reduce to mid teens or late teens, but somewhere in the future. Even today, though, we are firing on all cylinders and We also plan to open a large number of stores in FY27.
What is that large number, Chaitanya, that you're targeting to open for the year?
We are aspiring to open more than 75 to 80 stores.
75 to 80 stores. Okay. Briefly, Chaitanya, in terms of average spend per customer, customer retention, the customer lifetime value, frequency of product purchase, any insights you could give us from what you've seen for FY26?
Since these are not KPIs, we don't have the latest audited numbers. But to give a sense, our nearly 40-50% of furniture customers were customers of mattresses in the past. Nearly 20% of mattress customers were furniture customers in the past. And repeat forms a large double-digit percentage of our monthly revenue. So that means we don't rely on one and done kind of customers. Repeat, the flywheel going where customers keep coming back from different parts of the home with Wakefit is a very much a big part of our CRM strategy to reactivate customers. And that's the reason we focus on own channel, because in own channel, we get their phone numbers, email IDs. We're able to interact more deeply and keep telling them about new launches, price drops, sales, etc.
Chaitanya, pleasure having you today. Thank you so much for sparing time and joining us. Wish you good luck for the rest of the year as well. Looking forward to having you more often on the show. We'll take a short break. Back with more on the other side. Stay tuned. Now the markets have moved to the highs of the day. We are back at 23,800 now. The only question is whether that sustains or not. The currency continues to do well for itself. The broader markets too. But oil prices though, from the dip of towards 102 back towards 105. We take your leave on this edition of Trading Hour from Ritu and me. Thank you for watching. Halftime report on the other side.
Hello and welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Vinny Motiwala. At the day's high for the markets, rupee is appreciating again. So we have some fundamentals which are working well for the markets, but overall a lot of earnings which are trickling in. And that is something we'll be tracking today, Vinny.
Absolutely, a lot of earnings that are trickling as well. And obviously, we're seeing banks, financials managing to hold on to gains in the trading session. But talking about earnings, LIC is the first management on the show today. And the company has reported a strong set of numbers in Q4 FY26. New business premium has surged 20%, while VNB margins have also expanded. My colleague Yash Jain actually managed to speak up with the CEO and MD of the company, R. Doraiswamy, and began by asking about the quarter gone by and how they see the growth going ahead. Listen in.
It has been a continuous focus to see that the corporation improves its performance. Over the last four years, we have been very continuously focused on this. And we had taken some directional shift in the once we went public. Those efforts continuously on a single point focus has been helping the corporation in improve its performance. We have been focusing on product mix change. We have been focusing on the distribution mix change, as well as improvement in the operational efficiency as well. All three have been giving good results, and we could do very well in the second half of last year. And the entire financial year also, you found that we have shown a good growth in all the numbers, be it the net premium that we have collected, or the APE, or the VNB, and the margins as well. So it has been a continuous focus on improving all these areas, and this focus will continue, and I'm sure year 26-27 will also be progressing in this direction. Of course, we are also wary of the volatility in the market due to the crisis that is unfolding itself, but we are confident that we will be able to do well in spite of that.
Correct. Before I come to specific numbers for the coming financial year, the first 2 months have gone, first entire month and about 20 days of the next month of the first quarter. In the fourth quarter, there was a lot of chatter that there could be some postponement of buying because of the geopolitical issues. April has been good. We saw the numbers. What about the next month after April? Has the performance kept up the pace as April is concerned? And for the first quarter itself, what is the APE growth that you're expecting to come in for the company?
We would like to maintain a good, decent growth. Given the market conditions, we would like to do well. As you told, April has been good, as performance has been good. We would like to continue that kind of a growth for the month of May as well, and for the entire financial year. Of course, the impact of the current crisis on the individuals, only time will tell. But if the crisis persists for long, it can certainly have impact on the people's saving focus or ability to save through life insurance. But we hope that this gets resolved very fast, and we are able to continue our growth momentum the way that we have been growing. We expect it to continue to grow.
Okay. Now let's speak about some of the numbers for FY27. I won't hold you to 1 quarter or 2 quarters, but let's say for the full financial year. And this is something that we've been discussing at the start of every financial year. FY26 saw your VNB growing at about 42%, right? The margins growing by about 360 basis points. As far as APE is concerned, individual APE grew at 13% and total APE grew at 18%. On all these 4 counts, what is the internal target or the ambition for FY27 if you have to outline that for the investors?
No, as an organization, we have been staying away from giving guidance to the market or anything like that. But our focus will be to see that the industry's growth is strengthened by LIC's growth. So we would like to see that the industry grows, the pie grows, and together we march towards insurance for all by 2047. If that has to happen, the growth has to be really good. And the regulatory is on record. What's the kind of growth that is expected from the industry for the years to come? We would like to rise up to the challenge. We would like to see that we perform at a much higher level. But of course, we would not like to be less than double-digit growth is what we will look at.
On the top line,
on the top lines, yeah.
I'm specifically going to ask about the margins. If you look at FY26, you added about 360 basis points on the margin front. This was a difficult year because of various reasons. Let's assume and hope that if FY27 is a better off year, can one expect that you would add about, if not less than the same amount to your VNB margins in FY27? And if that is done, then your target could be about 25%?
I would like to certainly look at that kind of a number, but much depends upon how the market pans out. There are a lot of operational challenges in front. We would certainly like to expand on the growth that we have reached on the VNB margins.
Correct.
But taking that kind of an aggressive call to begin with, I would not like to be making it as an aggressive call to start with. But we will continue to work towards improving our margins in the year. That's for sure.
How do you see it? Achievable if it's a good year? 25% is in the realm of being achieved?
We have been telling that we would like to be matching the industry in terms of VNB margins, but it may take some time for us to reach there, but we are working towards it. That much I can assure.
Okay. One question we've seen over the previous 3 to 4 years, we've seen a decent growth when it comes to embedded value also. Same goes for this year. I want to understand from you as the management, but it's more of a shareholder question. The share price has not been responding to the kind of growth in the numbers, the top line, the margins, and the embedded value. What do you think is lacking at this point of time? And if you, of course, had to advise to your shareholder, the Government of India, as the management of the company, is this just a question of liquidity, or is there more to it that you would want them to look at?
So it can be one. Liquidity is certainly one of the factors. Naturally, the share realizing its value. If you look at the Bank of Maharashtra experience, when liquidity improves, naturally the valuation also goes up. That is one thing. Currently, liquidity is a matter of concern, but to address that only, we have come up with that 1:1 bonus issue. So the number of shares in the hands of the market, other than the government, has doubled. And we have also declared a good dividend on top of it. Last year we had paid 12 rupee on the pre-bonus number of shares. Now we have announced 10 rupee, of course subject to the approval of the shareholders, 10 rupee per share on the double the number of shares. So that is what we have announced. Thereby a 66% growth in the dividend has also been achieved. We expect the market to recognize the growth story of LIC, and the perception as well as its valuation should improve. This is our expectation. I am sure as things pan out, multiple areas: one, our performance numbers; two, the rewards to the shareholders; three, the government actions that particularly in terms of enhancing the float available in the market. All these things I am sure will go on to improve the valuation of the LIC shares, and certainly it is likely to realize where it should be.
All right, that's the word coming in from LIC, a big beat versus the estimates. The stock, though, has come up from the highs of the day. It was up around 5%, but then is up just 2.5% as we speak. But for the markets, we have picked up pace. The Nifty, which is up around 152 points, we're above the 23,800 mark. Again, there was some selling pressure from the top, so we came below the 23,800 mark. Nevertheless, it is a massive recovery from the lows of the day. And rupee is something that should come up for you on the screen as well. Below the 96 mark, and that is something that will be crucial to track from here on. So 95.94, that's the dollar to rupee level right now. But a lot of moving parts in the broader markets. Let's go across to Vivek. He's here to take us through the stocks that are moving around in trade. Vivek.
Well, good afternoon. It's a very strong green-looking screen on this Friday afternoon. Looking at some of the names that are doing quite well post the Q4 results. First on the list is LIC. We just heard the management, but the VNB margin is something that the street clearly is cheering over 2% higher on that particular name. Dalmia Bharat, a surprising acquisition. The company is now going to go ahead and reacquire some of the assets of JPA, and that particular stock higher by another 2.5% today. Ganesha Ecosphere, one name from the broad end of the market is doing very well, almost 10% higher. 32% volume growth in Q2 or in Q4. RCF, again, if you're looking at the numbers, extremely strong numbers on the P&L front. Profitability has more than doubled. That particular stock higher by 5%. Honasa, when you're looking at this particular name, volume growth over here, very strong underlying volume growth of over 30%. Stock higher by over 11% today. And on the other hand, quite a few laggards as well. Max Healthcare, that particular stock, top line miss. When you're looking at that particular name, stock beaten down, has recovered a little bit, but almost 4% lower over here. Paytm, Safe Partners has sold a significant chunk today. Stock seeing some selling pressure after that as well. Central Bank of India, Deepam has gone ahead and launched an OFS to sell the government stake. Almost 8% stake is expected to exchange hands, over 6% lower on that particular name. Glenmark Pharma, it's been an outperformer till today's trading session, but today, one of the top F&O laggards, some profit booking seen over here, over 4% lower. And Ashoka Buildcon, again, muted Q4 leading to a bit of sell-off in this particular name as well.
Okay, Vivek, thank you so much for that. Those were the stocks that are moving around in the trading session. But on that note, we're going to slip into a very short break. After the break, we'll connect with the management of Arvind Smart Spaces to discuss their Q4 FY26 numbers and the outlook of the company going forward. Stay tuned in.
Welcome back. You're still tuned in to Halftime Report. Let's get to the second management of the show today. Arvind Smart Spaces reported a strong set of Q4 number. Company witnessed highest ever bookings. Collections jumped 65%. To discuss this and more, we have Colleen Lalbhai, the chairman and non-executive director of the company, joining us now. Colleen, good afternoon. Thank you so much for joining in. 17% bookings CAGR over the last 5 years. Collections in this year as well have been at record high. What is the outlook going forward? Do you maintain this growth? We have been talking about maybe plateauing of real estate demand, but do you think for you this will not be an impact and you will continue at the same pace?
Yeah, hello, great to be here. Yes, I think we are seeing very strong momentum in our business, and consistently last 3-4 years, the way we have been growing. And we've added a lot of projects over the last 2 years specifically, where last year itself we added more than 3,000 crore GDV of projects. We have 6 new project launches, which we intend to do in FY27, which will be the highest in the history of the company. And in fact, we've guided for 35 to 40% growth. So we should be seeing an acceleration in our growth. Whilst I do agree that, the sentiments in the market could be turning cautious, I think structurally we are operating in a part of the market where we believe the underlying demand is very fundamental and structural. And therefore, we do believe we will have a good growth momentum moving forward.
Okay, you expect to have a good growth momentum moving forward. Colleen, hi, good afternoon. This is Vinny joining in the conversation as well. What about, obviously, collections then will improve, bookings will improve as well, is what the expectation is, right? Any guidance that you would like to give, a number that you would like to give for FY27, FY28?
So as I mentioned, whilst long term we have said, a cumulative growth rate of 30% is what we will want to achieve over a 4-5 year time frame. I think the next year will see higher growth. It should be more in the line of 35-40%, as I mentioned. And we've always focused on a lot of profitability and high IRR and cash flows. So our cash collection should also grow in line with revenue. And as a company, we have always had strong operating cash flow generation. So we generated more than 400 crores last year in operating cash flows, and we believe that sort of momentum will also continue.
Coming to cash flows, Colleen, because you have been a negative or you'll have been a net cash company so far. In last 2 quarters, you've seen net debt come by, right? 167 crore rupees in as of year ending FY26. What's happening with capex and the funding there? Are you going to be taking up more debt now? What is the cost of debt in that case? Will you be using more internal accruals? Give us a sense of what would the balance sheet look like.
Yes, so we are now in a heavier capex cycle. As you mentioned, last year we spent around 650 crores in capex, and this year will be slightly more than that. So we are investing heavily into future. Of course, most of that is being funded by OCF, but there will be some debt we would be taking on our books. We've indicated that we will always remain net debt to equity levels below 1:1. So you will see some more debt coming into the portfolio because we believe there's a lot more room for debt. We also now have our debt quite competitively priced. It's high single digit in our costs. So we do want to have some amount of debt on the books, but we will never let it get into any uncomfortable level.
How much would that be? Since 650 crore rupees was the capex last year, how much will you be accelerating it by? Are land buys in that capex as well? And what would that mean for your debt?
So that's what I was saying. It'll remain in that zone, 600-700 crores of capex in FY27 as well. And half of that is broadly what is covered by the operating cash flows. So you will see a few hundred crores of debt coming in, but it will be comfortably below the 1:1 level that we have put as our own leverage guardrail in the business.
Okay. Colleen, anything that you are looking at in terms of land acquisition, land buying as well? What is that in terms of your strategy and plan for FY27?
So we are a company that acquires projects and launches within a 9 to 12 month time frame. So we of course don't do land banking at all. We want to drive a high IRR, high return on capital employed sort of model. And we are also quite capital light. So our guidance is 60 to 70% of the land we acquire will be in a JD format, which is asset light. And around 30% will be in an outright format where we buy the land outright. So the capex numbers I gave are all for land acquisition, both in a JD and an outright format.
Okay. Colleen, Mumbai has been an important market for you. You added your first residential apartment project in Mumbai in the year gone by, looking at redevelopment as well. How big would Mumbai be a part of your portfolio? Can you split it for us right now? How much is it in Gujarat? How much in Mumbai right now? Bangalore also had some exposure. Going forward, what would the split look like?
So we have added some very exciting projects in the Mumbai region. We started with a horizontal 100-acre project in Mumbai 3.0, and now we have taken 2 redevelopment projects near the Western Expressway, one in Santa Cruz and one in Goregaon. The Goregaon will be the biggest deal the company has entered into. It's a 2,400 crore GDV project. And all these 3 projects we intend to launch in the second half of the year. I think we are very excited with the potential of the city. We're very excited with the 3 projects we've taken. And I think as they go online, there is an opportunity. I mean, I think this will become around 30% of, our annual sort of sale number. And the remaining 1/3 will be Bangalore and 1/3 will be Gujarat. So it'll kind of become quite an even, portfolio between the 3 cities. Sometimes if a large launch happens, it could move plus or minus 10%. But broadly, Mumbai will become close to 1/3 of what we expect our sales to be.
Okay. Colleen, thank you so much for joining us this afternoon on the channel and speaking with us about what we should expect from the company, the demand trends in the real estate side as well. So thanks so much for joining in and giving us those insights. But with that, we're actually going to slip into a very short break. After the break, we're going to connect with Dharmesh Shah of ICICI Securities, who will share his trading strategies. Stay tuned in. Welcome back to Halftime Report on CNBC-TV18. As of now, the Nifty is at 23,780 levels, slightly off the day's highest point, but still holding on to gains of around 130 points in the trading session. IT a bit muted in the trading session as well, right? But we've seen that run-up coming for IT. From week to date, when you look at it, Nifty IT is the top sectoral gainer, but today, slight bit of that muted performance from IT. Media, pharma continues to be under pressure as well, and banking, that's holding on to very strong gains. But on that note, let's also bring on board Dharmesh Shah, Assistant Vice President, ICICI Securities, to talk to us about his trading strategies, individual stock names as well. Dharmesh, good afternoon. Thank you so much for joining us on the show. How important is this 23,800 level going to be today? If we close above that, what levels would you keep an eye out on? And if we close below that, what will it indicate?
Oh, yeah. Good afternoon, Vinny. Absolutely. I think so. It's something I would say it's a fighting happening between the bulls and bears at the 20-day EMA, where if you look for last 7 trading sessions, we have been trading this range of 23,500 to 23,800. But one interesting point to highlight that if you see there is a lot of volatility, negative news like spike in crude oil prices, high bond yield prices, high dollar prices. After all this, market managed to hold on to the level of 23,200. So it looks like market seems to be digesting most of this negative news, expecting, I think so, 23,800 to see surpass in this current volatility. And we should be looking for a target from 24,400 for Nifty in the coming weeks. So yeah, it's something very interesting to be seen. If you look at the market breadth, I think so that's a good indicator to understand the sentiment of the market. That also has seen hardly any marginal deterioration in terms of market breadth. So even the percentage of stocks which are trading above 500 of total CNX 500 trading above 50-day moving average have been around 72%. So it's clearly indicating, I think so it's a broad-based rally. Mid caps, small caps clearly outperforming, and the way the technical setup seems to be forming for most of this Nifty 50 constituents looks like, I think so, in the coming days we should surpass 23,800 and should be looking for a target of 24,400.
Okay, all right. That's about the Nifty. Though the markets have come up from the highs yet again across the board, be it mid caps, small caps, or the Nifty. In a market like this, Dharmesh, what would your individual technical picks be?
Yeah, so if you look at the market, I think so it's something where you always like to stick with the relative outperformance. And here, if you look, I think so the power space as a whole really outperforming in this current corrective phase. Where inside the power space, again, BAIL remains to be a top pick. If you look at the BAIL, I think so the 18 years of long consolidation breakout has been witnessed in BAIL. Again, on the weekly and the monthly time frame, if you look, I think so, forming higher top, higher bottom formation, clearly indicating, I think so, there is a long way to go for the BAIL. For the short term to talk for BAIL, I think so, we believe the short stock should be heading towards a target of 436, keeping a stop loss of 388. Apart from power space, auto space as a whole, I think so, looks positive from the current levels. Yes, crude oil prices can be some bit of a dent to the overall auto space, but we believe, I think so, the way the crude oil price behavior looks to be, it seems to be on the verge of a breakdown. So auto as a space looks positive, where Tata Motors passenger vehicle looks positive. If you look at the chart, I think so, the stock has witnessed a falling trendline breakout, joining the lows of 2024 and 25 and 26, indicating the end of the corrective phase for Tata Motors passenger vehicle. So yes, Tata Motors passenger vehicle looks positive on the weekly, clearly forming a base formation about 20-day EMA, looks for a target of around 393, keeping a stop loss of around 337. So
Okay.
Tata Motors passenger vehicle and BAIL remains to be a top pick.
Okay, Dharmesh, thank you so much for joining us this afternoon, telling us his individual bets as well as the levels we should keep an eye out on. But on that note, it's time to also get the cues in the world of F&O this afternoon. Mangalam is here to take us through all of that. Afternoon, Mangalam.
Good afternoon. So the market is at, near day's high, but off day's high as well. And that's a pattern that we've been seeing over the last few trading sessions as well. If you look at the Nifty, a little over 23,800, it continues to see a bit of a sell-off. And that's something that if you notice over the last few trading sessions, the chart pulls up the highs that we saw on the Nifty from May 14th, May 19th, and thereafter May 20th, and as recently as May 21st, which was yesterday as well. Highs upwards of 23,800 are seeing a bit of a sell-off. So that's something that that we continue to monitor. The important part, however, is that the Nifty Bank is doing well. But as we move forward, technical resistances come by for the Frontline index, which is the 50-day moving average, above which we are on the Nifty right now. If you look at the 20-day moving average, that will come in as a bit of a resistance. Similar is the case with the Nifty Bank as well. Upwards of 54,000, between 54,600 and 54,700 are both the 20 and the 50-day moving averages for that index. If you look at the way the market's moved, however, the good part is that the base of the market is moving higher. 23,300, 23,400 is now moved higher to 23,500, 23,600 because we are seeing put writing at 23,700, 23,750, even closer to 23,800. But call writers, until we break out of this current congestion zone, are not giving up. So we are seeing some writing at the 23,800, 23,850 calls, all of them telling you that around 23,850 to 23,950, closer to 24,000, we continue to see some supply coming in for our Frontline index. Just a couple of things, even as the market's doing well, to monitor. One, the broader market's not doing extremely well. Secondly, the India VIX is higher. On a day like this, you would want the India VIX to be lower. And the third part that gives you a little bit of an eerie feeling is that, we are seeing the put-call ratio, which has moved towards 1.2. And typically, when it moves towards 1.2, between 1.2 to 1.3, we see the market overheat a little bit and sell off. So those are a couple of factors that I'm tracking. Even as we're doing well, we're not extremely comfortable about a breakout yet.
Yes, that's the main point about the uptick that we've seen in the markets as well. Maybe not so comfortable with the breakout yet. Thank you, Manglam, for joining us with that F&O setup. Time for another break. On the other side, Manisha Gupta will join us with Kunal Shah, Nirmal Bang Securities. We'll focus on precious metals. Stay tuned for that conversation.
Welcome back. Joining us on the show now is Kunal Shah. He is VP, Head of Commodities Research at Nirmal Bang Securities. Kunal, hi. Thank you so much for joining in. Your reading, first of all, on all the statements that we are hearing in and around about crude oil from US, from Iran, mediation that Pakistan's trying to do. And the crude oil prices in the meanwhile have actually come off its highs, down nearly 4% for the week.
What I'm able to make of whatever is going on, I think considering that the US midterm election is on the verge, the likelihood of the deal between US and Iran is now very high. So there can be a deal in next 7-10 days. I don't know. I cannot tell it with precision. But the body language, whatever I'm able to understand, and the statement which are coming out, they are indicating, because we are at that point that oil, if this is going to continue, should have been at $120 to $25. Instead of that, oil was not able to move up, and with every statement coming from US, we are seeing that oil was retracing back very quickly. So my sense is that we are going to see what we are going to see is something like a scenario where oil is going to remain under pressure, and there is a strong likelihood of a deal taking place between US and Iran. So I think WTI is heading towards 95 and Brent is heading towards $97, $98 by the end of this week. And I'm expecting some positive announcement going forward in next 6 to 7 days.
All right. So the next 1 week clearly can be important. There could be some retracement that we could be looking at in both of these crude varieties. Kunal, how are you also looking at the Indian rupee now? Because a very sharp appreciation onto this one, something that the markets perhaps are reacting to various RBI steps that they have promised. The swap, for example, 95, is that coming? Or do you see more appreciation?
I think if rupee would have continued to remain at the levels where it was, it would have been a very bad scenario for our country. They had to do something about this, and I think they will continue to do that. My sense is that maybe for a time being, I would stick out my neck and say it has peaked out already. So if the US-Iran deal is taking place, the likelihood of it going to 94.50 is very high in a current scenario. And I think it should not go above 97 now. And we may see 94.50 kind of levels in next 10 to 15 days. And it can appreciate further, not on a basis of the actual fundamental, but the expectation of oil to go down, expectation of deal, and the measures with the RBI taking currently. I think in short term, it has peaked out.
How are you looking at the gold and silver prices now? Because the dollar index is slightly off its highs, and that perhaps has been supportive for gold and silver. But when you look at both of these precious metal prices, gold is off 14% from its highs. Silver is down 20% since West Asia conflict began. Is that impact already in? Do you see further pullback in gold and silver before we see a buying momentum coming again?
I think there's not going to be a significant upside in gold and silver in near term. Two reasons. One is the Indian imports are likely to remain under pressure. India's demand is also going to go down with the measures the government has taken and the appeal the Prime Minister has made because of that. This is an off season where the demand generally remains very low. And now we have to see the El Nino year. So the monsoon, if it doesn't remain good, then that will be more bad news for gold and silver. So I think in short term, the demand may remain weak in India. Internationally, if you ask me, whatever is happening because of that, gold prices may bottom out at $4,400 kind of level on COMEX. And I think it can again resume and test levels of 4,750 to 4,800 going forward. So I'm not very bearish on gold because of the global phenomenon. The Indian drop in demand can have some temporary impact, but eventually gold should perform better and should be able to give you 10% return from $4,400.
All right, that sounds good. How are you also then looking at the metals as a space? Because we've seen copper prices trade very close to its all-time highs, teasing those numbers yet again, but not getting there. How would you look at the demand scenario going forward? The whole AI stocks clearly seem to be lending that support to copper prices in the last couple of sessions.
I think I said it in your last show, and I said it even at this levels. It still looks very bullish to me. It's no-brainer. The metals are likely to do well. It is likely to outperform precious metals, and the fundamental continue to remain very bullish. The supply chain disruption, what we saw lately because of this war, is likely to weigh on the supplies going forward. A lot of countries are now, talking about the protectionism, and they are not. So, like for example, Indonesia, they are talking about cutting the exports of so many commodities to the world. So if copper is one of them, I think we are in a big problem. So the supply of copper may severely get impacted because of that. So my sense is that whatever dip you get is a buying opportunity, and $15,000 looks very likely. It is going to test, and the fundamental of copper, aluminum remains very bullish.
If you had to stack it up like in sense of gains, would you put copper first and then aluminum, then zinc? Is that how you're playing it?
Yeah. So copper, aluminum, nickel, zinc, this will be the order.
Are you also looking at the dollar index declining from here? Because if we have to get positive in commodities, then are we looking at dollar index staying around that 97 to 99 of a range?
I think lately what we've seen is because of the inflationary expectation, PPI, CPI, both have significantly shot up. That's the reason why dollar index is at 99.29. But going forward, once there is a deal between US and Iran, if it then I think dollar index is heading towards 97.5 dollar again, because $40 trillion of debt, it's absolutely a no-brainer. It's just in near term, the inflationary expectation have surged so much that the dollar index is trending. But going forward, it should gradually ease.
Understood. Kunal, thank you for joining in as always. So that is the view really coming in for the currencies and commodities as well, where the weakness in gold perhaps may just about continue, but buying in base metal prices is something that you should perhaps be doing in your portfolios there. With that, we'll go for a short break. But up next, we will connect with Ann Tan. He's the co-founder at Active 8 in our Crypto Corner segment. Stay tuned.